You're seeing this upward pressure on bond rates.
The Treasury won't have enough power to control the 30-year yield.
There are just too many competing factors out there that are moving long yields.
Markets do not want to see anything standing still. They need to see action.
Markets are telling you what they will do if the Fed continues to sit on its hands.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, beginning a high-stakes week. NASDAQ futures pulling back, heading into earnings from Nvidia as investors are gearing up for Scott Bessent's address on economic policy. And Fed Chair Kevin Warsh's much-anticipated speech in Jackson Hole. That speech just days away.
And it got a lot more focus after what we saw last week from Treasury Secretary Scott Bessent, and a real question about how much an ambiguous tone from Fed Chair Kevin Warsh led to the rise in longer-term yields. A couple of questions here. A, will he say anything? B, will he say anything about reaction function? C, will he say anything about Fed Treasury coordination? And D, how will the long bond react if he comes out in a more hawkish or dovish way? Do we see a real reaction there, implying that some of the move really is up to the Fed response mechanism or unclarity related to that?
There may well be a bigger message in saying nothing this Friday, and the bond market will have its own opinion on that a little bit later this week. Also looking out for Scott Bessent later on this afternoon, potentially. That's the timing of things. Looking for something around 2 p.m. Eastern time to address the economic warfare, D-Day for the Iranians. This is going to have some major implications for the bond market as well. Crude, the move, we're all familiar with it since this war started, up around 30%. 30-year bond yields over the same period up by more than 60 basis points. It's one piece of a much bigger puzzle, but it's an important piece of that puzzle. If you can address the situation in Iran, you can help put a lid on that picture right there.
A lot of people, even included within the Federal Reserve, have talked about how higher oil prices and the trajectory of the Middle East conflict very much is a huge factor in exactly what the inflation outlook will seem like and exactly the path of their policy. Scott Bessent, in his editorial, his op-ed in the Financial Times, said, "At dawn begins an economic D-Day, the single greatest financial offensive ever marshaled against an adversary." Who is the adversary? Is it Iran? Is it the allies of Iran? How far does this go with respect to China, one of the biggest trading partners, not to mention the UAE and Turkey? You start looking at this and you start wondering, what else does this potentially unleash, including one of the biggest holders of U.S. Treasuries? I mean, if you want to go there, this also has that implication embedded in it as well.
It was one of the first things I did sitting around this table this morning. I pulled up the FT piece on the Bloomberg terminal and searched for one word, didn't find it. China.
Yeah.
That's the elephant in the room into this afternoon.
China is the #1 trading partner with Iran. It is the purchaser of the bulk of the Iranian crude. They came out over the weekend saying we really encourage a diplomatic solution to this conflict in the Middle East. Exactly what their response will be to any potential of financial offensive by the United States and how much the tit for tat will really escalate into a meeting between Xi Jinping coming to the United States to meet with President Trump remains to be seen.
That's one to watch a little bit later on today. This is one to watch right here, right now. The race to raise capital. Check it out. Over in Japan, SoftBank tapping the debt market for $6 billion. Over in Hong Kong, Alibaba tapping the equity market for 10. This all ahead of a major slate of bond issuance this week. Back in focus, the belly of the curve, 5s and 7s in the middle of this week.
Yeah, to me, so we've got the auctions, of course, this week from the U.S. Treasury Department. 7 years will be really interesting. In particular, with all of these debt sales coming from every corner of the world, what you are seeing is an increasing premium tied to this debt. At what point do you start to see companies not raise as much money, or does this continue to be the tsunami that keeps on regardless of how much pushback you get from investors?
Futures down this morning by about 0.1% on the S&P 500. Coming up this hour, we'll catch up with Steve Chiavarone of Federated as equities snap a 3-week winning streak. Stephen Cook of the Council on Foreign Relations, with the U.S. preparing to launch economic D-Day on Iran, and Kelsey Berro of JPMorgan Asset Management heading into Jackson Hole. We begin this hour with stocks inching lower, going into a week packed full with event risk. Steve Chiavarone of Federated Hermes writing, right now, the market wants to rally broadly. If volatility arises, we would be buyers. Steve joins us now for more. Steve, good morning.
Good morning.
What kind of debate do we need to settle this week with that address from Scott Bessent and then later this week from Kevin Warsh?
Well, I think you're right to tie the two together. I mean, I think they are a package deal. And I think that was part of the allure of the candidacy of Chairman Walsh. I think you saw that last week, right? I mean, while Warsh has tried to downplay the balance sheet kind of aspect of the Fed, you saw Bessent step in with Treasury and talk about using the balance sheet to try to manage that rise in longer-term yields. Look, I don't expect that all of a sudden a very tight-lipped Chairman Warsh is going to, start doing his Jerome Powell impersonation at Jackson Hole this week and, tell us every detail about his plans. But I think it's relatively clear the direction that he's going in if you want to listen. It is less forward guidance. It's not no forward guidance, but it's less forward guidance. His fascination with trim mean versions of inflation measures as opposed to the classic core PCE tells you that he's not going to overreact to one-offs, right? And then I think his move towards these kind of these working groups that he has is another step in asserting the Fed's independence. So I think you're going to get some maybe more details around framework from him, but I would not expect him to lay out the entire plan. I think probably the bigger event is going to be the Besant speech today and what an economic D-Day looks like and how that's different from pre-war Iranian sanctions. But look, at the end of the day, I think the big story here from the market's perspective is actually what you just highlighted in Asia. The largest companies in the world financing the largest infrastructure build in any of our lifetimes are still raising capital to increase that CapEx more, which is driving an unprecedented earnings cycle, the sharpest 2-year revisions higher in earnings estimates ever. And that's what's driving markets higher, and that's got to be your North Star.
Does one risk undermining the other?
There's one, no, because the reason it doesn't is a couple of things that are going on. One, remember, these borrowers are less rate sensitive than your normal borrower. They're still, even though you're starting to see some of the hyperscalers take on some debt, relative to the average company, it's very low levels of debt. The balance sheets are very clean. The vast majority of this investment is being done through free cash flow still. And those free cash flows are rising with these companies. It's not like they're not having the earnings growth that's growing into these CapEx numbers. So this is one of the least rate-sensitive investors. And when you think about the overall expense profile for these guys, whether it's just interest expense or even energy expense, it's small relative to the chip expense and the memory expense. If they're able to kind of swallow those, they're able to handle interest and energy. And remember, each of these hyperscalers rose through prominence by killing their forebearer, right? Like no one is going on MySpace or using a BlackBerry or searching on Yahoo. And so they understand how important transformative technology is. They're not going to lose this race. This is existential for them. And so the CapEx continues unabated. Yeah,
they might not lose the race, but the race might be maybe losing steam in terms of the pace of acceleration. And one thing that Urian Timmer of Fidelity said over the weekend is, are we hitting peak earnings growth? That it's unlikely that we're going to see earnings growth continue to accelerate at this pace going forward. Isn't that enough to put some question marks around how far the valuations, the multiples, can really continue to expand?
Not historically. So if you think about where you are, yes, we're at 50% year-over-year earnings growth this quarter. And some of that, probably 20% of that is kind of one-off. So it's really a 30% growth rate. We think maybe next year looks more like 15%, which is slower. That would be peak. Historically, though, what you'd see when you get a big earnings jump like this, but earnings remain positive, is the market continues to do well. Now, what's different this time, and this is what's really remarkable, is you've never seen this kind of earnings growth not coming off recession, right? You don't see 50% earnings growth 6 years after your last recession. You see it in the 12 months after. So this is a very different kind of earnings cycle. But what I think you're likely to see is a couple of things. One, that the multiple holds. And the multiple holds for a number of reasons. One, you have visibility on these earnings. These are highly visible earnings. Micron already sold everything that they're going to make next year. GE Vernova has sold turbines into the ended time. So there's a stability on those earnings. The numbers keep moving higher. The estimates keep moving higher. The revisions stay positive. And what you've done with the economy, remember this, and it's one of the reasons why the multiple is where it is that the margin profile of the S&P has gotten higher. As higher margin companies that sell more repeatable goods are a bigger part of the index, and so you're going to pay a higher multiple.
So we're going to get Nvidia earnings on Wednesday. That's going to be key into this whole story. A lot of people are expecting really good earnings. Question is just how the equity market is going to respond to that, given what's baked in. How does the bond market figure into this? I mean, how much does all of this rosy outlook get predicated on the idea that the Fed's going to hold rates where they are or even cut them at some point in the future?
Well, let's talk about the long end real quick, and then let me answer that directly. So the long end didn't just start going up when Chairman Warsh became chairman, right? It's a 6-year trend where the 40-year bond bull has kind of ended. So what's gone on, right? Well, one, I think trend growth rate in the United States has changed, and I think trend inflation rate in the United States has changed. I don't think we're in lower for longer. I don't think we're in a sub 2% growth environment. I don't think we're in a sub 2% inflation environment anymore. I think that's something more like 3-ish% growth underlying and 2 to 2.5% inflation. That's higher nominal GDP growth. Higher nominal GDP growth requires higher nominal yields, right? And you saw these kinds of yields in the 1990s in a productivity boom, in a strong economic growth period. So I think what you have is that bonds have to compete with equities, right? They've been under pressure. They didn't hold up in the sell-off of 22. That's very much in people's mind. And so if I'm going to buy a government bond right now, particularly when there's so much supply of great corporate debt that's out there, and equities are growing earnings the way that they are, I want to yield. And so I don't think that's unhealthy. I don't think it's being driven by some material change in the budget picture. Budget's been lousy forever.
So why do you think the Treasury's so uncomfortable with it?
Well, they're uncomfortable with it because from a government's perspective, you want to finance inexpensively. So they want to manage that rise as they should. But I don't think that it represents some fundamental risk to the economy. If you think about it, one, the 10-year yield has been relatively behaved. It's not like the 30. That's where corporates are borrowing. The only area of the economy that's under real pressure from that 30-year is the housing market, which is obviously a priority for the government. But that's not what's driving economic growth right now. It's borrowers that have a lot of cash flow. It's high-end consumers that are cash flow
You see this
positive.
as sustainable?
We believe, and this is primarily on the equity side of Federated, but we believe that over the next 5 years, you're likely to see the 10-year yield be north of 5% on average. And by the way, we don't think that that is some death knell for equities. We think that that can coexist with continued strong equity markets.
I asked the question because the president seemed prepared to drop bombs on the bond market over the weekend. Do you see those comments?
Oh, yes,
Still
I
trying
did.
to make sense of that. I don't know if you saw those comments. He started talking about military intervention.
Well, there's some people who actually were talking that maybe he
I'm
is
assuming he didn't hear the question.
I'm assuming he didn't hear the question. Some people were saying he actually thought that they were talking about oil prices going up. And because ultimately, how else would you say, what other options could there be for Scott Bessent? If you didn't see it, he was asked, what other options are there? Scott Bessent's intervention in the bond market had a limited action. Would you consider other alternative interventions? And he said, ultimately, the most extreme intervention is the military. And if we have to use our military, we will. And then it led to an incredible number of memes that were incredibly enjoyable. I spent a lot of time over the weekend looking at them. And someone in my household said, you need to find a new hobby.
I would just say I'm really glad to be an equity investor.
after that to be bombed.
Yeah.
When they start panicking, you can start buying.
I don't know. Is
Right?
that really what you want? Do you buy the?
Felt like
I mean, where would you, Bob?
I've got no idea, Bram. I don't even want to go there. Don't even want to start. Steve, it's good to see you.
It's great to be here.
Have a great week, buddy. Thank you. Steve Chiavarone there of Federated. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Fonnie Quinn has more. Hey, Fonnie.
Good morning, John. Tensions escalating between the US and Iran as Treasury Secretary Scott Bessent signals plans for fresh sanctions today and threatens a, quote, economic D-Day, with Tehran threatening to seize vessels that violate transit rules in the Strait of Hormuz. Trade talks between the US and Canada falling apart following Donald Trump's threat of 50% tariffs on some of the country's exports. Canada's Prime Minister Mark Carney now planning to implement counter tariffs on $20 billion of US products effective September 8th. Alibaba raising more than $10 billion in Hong Kong's biggest share sale as the tech giant pushes to get ahead in the AI race. Sources telling us here at Bloomberg, institutional demand was almost 3 times the offering. Alibaba will be subject to a 90-day lockup. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time later this hour. Up next on the programme, severing Iran's economy.
We're seeing what happens. They have no money. They have no Navy. They have no Air Force. They would love to make a deal, but they're not ready to make the right deal, in my opinion.
It's loud when you're asked questions in those moments. It's loud.
Sure.
Perhaps he didn't hear.
My favorite was, we need to prevent the bond market from getting a nuclear weapon.
That came too. That was a meme.
Yeah, that was one of them, which I loved.
Yeah.
It's sort of like, well, ultimately the bond market has the ultimate nuclear weapon, at least financially.
I've said this about X a few times. Some of the content right there is so good at the moment.
It's fantastic.
I've had to limit my usage on my phone.
Yeah, I'm sorry.
To 1 hour a day.
I get it.
Because the memes are that good.
They are that good.
Stephen Cook of the Council on Foreign Relations joins us next, live from New York City this morning. Good morning. Here's the week ahead. It starts right here. Later on this afternoon, the Treasury Secretary Scott Bessent addressing the nation and arguably the global economy. He's calling it D-Day for Iran. That press conference taking place at 2 p.m. Eastern Time. The week picking up with PCE data on Wednesday after the closing bell, earnings from Nvidia on the same day, and then at the very end of the week, Brahma will be there. Jackson Hole, Wyoming. Chair Warsh addressing the Federal Reserve.
Yeah, a lot of people aren't expecting much just because he has had a policy of not saying all that much. Nonetheless, even if we hear about the task forces and what the development is there, even if we get a sense of whether he delivers more of a reaction function in response to some of the criticism, it will be important, especially following what we hear from Scott Bessent later today.
That's the week ahead. This is the price action. Equity futures pulling back by 0.2 on the S&P 500. On the Nasdaq, we're down by 0.6. Coming into Monday, the Nasdaq, one update in the last 6 sessions. Last week, not a great week for the S&P or for the Nasdaq 100. Under surveillance this morning, severing Iran's economy.
We're seeing what happens. They have no money. They have no Navy. They have no Air Force. They have 350% inflation. So we're just going to sort of see what happens. We have total control of that entire region having to do with the Strait of Hormuz. They would love to make a deal, but they're not ready to make the right deal, in my opinion.
So here's the latest this morning. The Treasury Secretary Scott Bessent set to outline new sanctions on Iran at a news conference later on today. Bessent writing in the Financial Times, an economic D-Day is coming. Bloomberg's Tyler Kendall has more. Good morning, Tyler.
Hey, John, good morning. Well, a heightened threat from the U.S. Treasury Secretary against Iran and its trading partners. It's raising questions about whether the U.S. today will go after Chinese refiners of Iranian crude and the banks that fund them. New data shows us that Iran's oil shipments to Asia have all but dried up already, with traders familiar with negotiations now telling Bloomberg News that prices have flipped from a discount to global benchmarks to now selling at a premium. Escalation could, of course, pose risks to the U.S. China trade truce at the moment, exactly 1 month away from the Chinese President Xi Jinping being here in Washington, with new comments this morning from Beijing actually urging diplomacy that they would like to see talks resume. In fact, we heard a very similar message from some of the relatively more moderate figures of Iran's government, including the country's parliament speaker, as well as the president, who are citing how Iran's economy is already under enormous strain, with inflation reaching 80%. But still, John, the country has weathered waves of sanctions before, and the IRGC told Iranian state media over the weekend that they have a range of options to retaliate, which has prompted analysts to say that the region is now on high alert for targeting of Gulf state energy infrastructure.
Tyler Kendall with the latest in Washington. Tyler, thank you. Stephen Cook of the Council on Foreign Relations joins us now for more. Stephen, good morning. This in the Financial Times this morning from the Treasury Secretary. The world should understand that our objective is to sever every economic lifeline that sustains the tyrannical regime until Tehran stands alone. Stephen, is that possible without taking on China?
Yeah, you've got to take on China. You've got to take on the United Arab Emirates. You've got to take on Turkey, Iraq, Pakistan. All of these countries. The Chinese purchased about $10 billion worth of Iranian oil. Trade between the UAE and Iran is $38 billion. I know the Emiratis have announced that they were ending all trade, but nothing on the ground really has changed. Dubai is a very, very important trading partner for Iran and vice versa. So we'll just have to see whether these countries comply with what the president and the Secretary of the Treasury have to say on this. But it is going to be difficult, especially now that the IRGC is saying we will retaliate. And they will retaliate by using force. They don't have really any economic measures to use against these countries. But certainly you can imagine energy infrastructure coming under attack by Iranian drones and missiles.
Stephen, can you just give us a sense of how different this type of economic retaliation by the United States on economic partners of Iran, how different that is from existing sanctions that had been in place for years?
Yeah, this is actually quite different, because what it is doing is, instead of targeting Iranians per se and Iranian entities, it's actually targeting their partners abroad, which provide financing, supply chains for Iran's technology that goes into its missile program and drone program. So it would, if successful, be very, very significant. The question is whether the president has the stomach to take on the Chinese over this. As Tyler pointed out, we're a month out of a summit meeting between President Trump and President Xi. The United Arab Emirates is an extraordinarily important American partner in the region, but we've been willing to overlook their trade relations, not only with Iran, but Russia and others that we don't like. So the question is whether the president who likes Mohammed bin Zayed, the president of the UAE, whether he's willing to take him on as well. These are important relationships that the United States has, and the president has often in the past been full of bluster and not carried through on his threats.
Let's say he does carry through with this, and let's say the U.S. does execute and fulfill its promise here. What would the efficacy be? I mean, how much could it contain the conflict more than it is currently?
Well, like I said, the Iranians have threatened energy infrastructure across the Gulf, which would be yet another escalation requiring the United States to respond. The other question is whether cutting the Iranians off would do much in terms of trying to collapse the regime. That is the theory of the case here. Yet, throughout this long conflict now, the Iranian regime has continued to kill and prosecute people who they believe have been engaged in anti-regime activities. This is on top of the thousands that they killed in December 2025 and January of this year. So far, the regime's grip does not seem to have loosened a bit on the Iranian people. So if the idea is to collapse the economy and therefore collapse the Iranian regime, there is not necessarily a causal effect between one or the other.
Well, Stephen, let's talk about our economy and not just their economy. And let's talk about the bond market in this country right now. It's certainly not a crisis. And the backdrop for this economy, we're still churning out, I think, 6% nominal GDP in America. The backdrop for growth is fantastic, but clearly the Treasury Secretary is increasingly concerned about what's developing in the bond market. Does that compromise our approach on the international stage when we engage in these kind of issues with countries like Iran?
Well, certainly America's credibility abroad on a whole range of issues, whether it's the bond market or whether it is the president's constant threats of escalation and then backing down, or whether it's trade wars with Canada, threats to take Greenland. All of these things undermine American credibility abroad. And the question about economic management and sound economic policy, it goes hand in hand with geopolitics. And so it is quite extraordinary that the United States, which has long been the source of stability, both geopolitical stability and economic stability in the world, is now the wild card.
Stephen Cook of the Council on Foreign Relations. Stephen, thank you. On that issue, I think that Mark Carney, the Canadian Prime Minister, alluding to the same thing. The backdrop for the American House right now down in Washington, D.C. is a little bit more vulnerable than it has been. Which,
again, goes to the question you were asking. How much could the retaliation, say, from China be selling treasuries and be part of the issue? And even if that's not the case, how much were the sanctions tied to Ukraine and Russia and some of the way that the U.S. handled that really what kicked off a key selling point for a lot of nations who are big holders of treasuries?
The massive rush into gold.
Yeah.
How you manage dollar reserves. Big piece of the conversation, I think, Bramo. We saw the gold buying really start to build up around the Ukraine issue. And as for treasuries, I don't think it's a matter of people selling them actively. I think the story over the last several years, and we've both been following it, is just buying fewer and fewer of them. And you've seen that from the Chinese.
Yeah, unless they have to sell for currency intervention like we saw over in Japan. So there is that as well. On the flip side, Mike Wilson had a note out saying that a spike in the price of oil is potentially the key risk for equities because it would mean that there could be some response from the Fed. So it's kind of damned if you do, damned if you don't right now, if you're Scott Bessent.
It's a tough position, that's for sure. Up next, we'll talk about a big earnings report later this week. Dan Ives of Yorkville Ives, as Nvidia warns of price hikes just going into earnings in a few days' time. Live from New York City this morning, good morning. Equities retreating this morning. We're down by 0.2 on the S&P 500. On the Nasdaq 100 so far this morning, we're negative by 0.6. Last week, snapping a 3-week winning streak on the S&P. Beneath the S&P, sector to sector, the financials snapping an 11-week winning run. What a run we've seen. Before last week, we hadn't seen a down week for the financials. since the end of May. In the bond market, 2s, 10s and 30s with lots of attention on the 30-year piece of the yield curve. The 30-year this morning at 5.25, yields coming in by 2 basis points. Last week, up a single basis point, up 1 basis point, working tremendously hard to stand still in the bond market. That's the headline into last weekend. And as you work hard to do that, these are the consequences. You'll hear lots about the so-called debasement trade. I'm sure you read tons about it. Check out the dollar, check out Bitcoin, check out gold. This morning, the dollar a bit stronger, gold higher again, Bitcoin up too. Gold last week up by more than 5%, Bitcoin up by more than 20.
The debasement trade was very much the trend last week when people were talking about the potential for the U.S. Treasury to try to pin the long end of the yield curve and then what potential response there could be from the Federal Reserve. I would argue that the person who could potentially confirm or deny the idea of this debasement trade is Kevin Warsh on Friday.
Kevin Walsh, a few days away. Gold this morning, up another 0.9%. Counting you down to the cash open, 3 hours away. Let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We are seeing some weakness in Alibaba ADRs, down 2.3% after the Chinese firm raised more than $10 billion in a record follow-on share sale over in Hong Kong. And it comes just after Alibaba reported results last week, where it saw a 75% profit plunge as AI spending ramped up. So now it's turning to shareholders to raise even more money for that AI push. And remember, among Chinese firms, Alibaba comes to closest to the spending we're seeing from the U.S. tech firms, though still pales in comparison. Meanwhile, we're seeing the U.S. steel makers also gaining in the pre-market, names like Nucor and Steel Dynamics, after trade talks between the U.S. and Canada broke down. That means those steep 50% tariffs on Canadian imports are staying in place, giving domestic steel producers some protection from Canadian competition. But remember, Canada is hitting back with tariffs on U.S. steel starting on September 8th. And we end on Applied Optoelectronics. This company has been a major AI winner. It makes the optical networking equipment that helps move huge amounts of data through data centers, and shares are up more than 200% year to date. But as you can see, they are taking a hit, down 13%, after it said it plans to raise up to $600 million by selling new stock, which of course is a diluting event. John.
Yahira, thank you. Thanks for the update. More from Yahira in the next hour. On our radar this morning, Treasury Secretary Scott Bessent set to detail new sanctions on Iran today. Bessent writing in the Financial Times, at dawn begins an economic D-Day, the single greatest financial offensive ever marshalled against an adversary. Elsewhere, trade talks between the US and Canada collapsing.
I warned that America is trying to break us so they can own us. And I promise that that will never, ever happen. Canada is becoming stronger and less dependent on America, and we are just getting started.
The Canadian Prime Minister Mark Carney announcing retaliatory tariffs. Sources telling us here at Bloomberg the Canadian government sees little chance of talks resuming before the midterm elections. And finally, Alibaba shares posting its biggest single-day drop since early 25 after raising a record $10 billion in its Hong Kong share sale. And SoftBank looking to fund AI ambitions, planning a record $6.3 billion retail bond sale in Japan.
It's really notable that the market remains as wide open to some of these debt sales and share sales as it has. If you think about it, so far this year, AI hyperscalers debt issuance has reached about $220 billion. That's according to BNP Paribas data. That is compared to $12.5 billion for the similar period last year. I mean, this is a huge magnitude higher, and yet spreads haven't widened all that much. Yes, you are seeing a bit of pushback. So if you're a tech company, why not raise money? If you're SoftBank, why not raise bonds tied to your OpenAI investments? If you're SoftBank, if you're Alibaba, who cares if your shares go down 8%? If you're going to dilute it, if you could raise money potentially for the growth. And ultimately, that's the calculus they're making.
You've seen some pushback to single names without a doubt. But to your point, you're looking at a record year of issuance, potentially. We're on track for one. And investment-grade spreads are wider on the year by 2 basis points. That is nothing. That is nothing. That's a welcome mat to carry on issuing debt.
Even though you have seen, for example, the Amazon sale, you did see spreads
some pushback, sure,
significantly wider in their recent sale versus earlier this year. It is a different dynamic. Nonetheless, that isn't a cost that's a deal breaker. If anything, it still is a green light to issue. Again, this goes to the question of the competition for capital, and this goes to the question of what's driving yields higher. If you have all of these companies coming out and saying, we're going to keep issuing, this is still an attractive rate for us. Well, over to you, Treasury Department. You don't have the same growth engine. You don't have the same potential productivity that you're going to use for that money that you're raising. But guess what? You're going to have to pay the same rate.
Spreads are tight. The increase in yield is coming almost exclusively from the Treasury. To get Bremo excited in the morning, you just go on the Bloomberg terminal, ECO space 20 space US. Then you get a list of supply from the Treasury. So this is it. I've got the function in front of me, loaded and ready to go.
Thank you.
$69 billion in 2-year notes tomorrow. The day after, we've got $70 billion in 5-year notes. The day after that, we've got $44 billion in 7-year notes. The supply keeps coming.
Yeah, the drama, it's building slow like a novel. This idea of the 2-year probably being fine, the 5-year being like, a little more sketchy potentially, although you could see some bond buyers coming in. The 7-year, oof, that's going to be a hard one given the fact that it's not as a normal of a one and doesn't have as much liquidity.
It's been messy at times, that particular auction.
How much is that part of the reason why we saw the Treasury step in?
Let's give it a few days. The 20-year, that one was a bit of an orphan on the yield curve too.
Yeah.
Yeah, and people are asking, they're speculating what kind of 20-year auction we might have had last Wednesday if the Treasury Secretary didn't get involved.
Yeah, 7 years probably a little more immune, but let's see.
We'll see. A few days away, looking out for that. Let's talk about Nvidia posting its longest losing streak in 4 years, going into earnings on Wednesday. The chip maker now telling its biggest customers AI chip costs are set to climb more than 15%. Dan Ives of Yorkville Ives writing, we expect robust results from Nvidia, which will be key to the tech trade going higher into year end. Dan joins us now for more. Dan, good morning.
Great to be here.
What's getting more expensive?
Look, memory. I mean, look, the reality is that we're seeing a memory super cycle take place, and I think that's the word all around Korea, and that's why Nvidia, they're going to need to pass some of this to their customers. But that's not slowing down, because the reality today, demand to supply for chips is upwards of 15 to 1. And I think that's what not just Nvidia, but ultimately their end users.
Who needs to eat the higher costs right now? Who's eating it?
Now, through the supply chain, you'll see some of that eaten. But then ultimately it's the end user, it's the customers, it's enterprises, it's tokenization. As that all plays out, then the question will be, okay, when do you hit some sort of equilibrium? I mean, we don't think you hit core equilibrium probably till middle to late 2028. And I think that right now is the quagmire, whether it's Nvidia, whether it's the memory players, Micron, everyone else, because the hyperscalers, just like as Lisa talked about, as they'll continue to raise capital and CapEx will continue to increase, the AI revolution is still in the third inning, and I think you'll hear that more from Nvidia later this week. Then it comes down to like memory, and Apple, and obviously seen that front and center. Those costs are going to continue to go up.
They're going to look for other costs to go down, though. And I was looking, for example, at the story over the weekend of Nvidia potentially telling some of its customers, like Microsoft and Alphabet and Oracle, that their costs are going to go up about 15% tied to data centers because of the memory chip and how much the price is going up. And you start wondering, is this part of the reason why they're cutting back on frontier models? Is this part of the reason why they're looking for efficiencies from, say, open-sourced AI models coming from China?
Yeah, and that's why when you look at Apple and they looked at chips potentially from China, because they're looking across the board and say, okay, where do we cut costs? Because on one side of the ledger, costs are going up. But it speaks to our view that until you really hit scale, costs are going to continue to go higher. I think with the hyperscalers and with the chip players and from Nvidia, what everyone's dealing with is you cannot take the foot off the gas right now, because of the demand cycle. And to your point, when it comes to like the debt raises, despite what we're seeing, that's going to accelerate. I mean, you talked about it going to 220. You go to next year, it's probably double from that, in terms of as it's going to continue to increase, given the CapEx that's needed. In terms of what I'll view it as building Vegas Strip 1955 type movement.
I was looking at Nvidia's earnings and just the returns that you've seen in their shares. So far this year, their shares are up 15%. Last year, they were up 38%. The year before, they were up more than 100%. The year before, up more than 200%. It's been a rapid deceleration in the equity returns as multiples have gone higher and higher. At what point have they just reached a pinnacle of what multiples can look like? And even if they deliver amazing results, they're not going to get that kind of pop in the stock.
I think that's the debate. But then to some extent, they've almost funded the AI party. I mean, if you think about the memory play, look, think about Korea. Kospi is not where it is without Nvidia. There is only one chip in the world fueling the AI revolution, that is Nvidia. And I think the point here is that as you see with numbers as it plays out, there's no one that has a better perch than them. And that's what I think you'll hear from Jensen, because the question is it, as enterprise accelerate, and we think accelerating probably 20-25% even over the last few months, as that runs through the system, it's investors ultimately recognizing that, because it's my view investors are still underestimating the scale and scope of the AI revolution. Now, it goes back to like the bond market, and you're going to need to take out more debt. And then where is there a patience, sort of a tug of war that goes on. But from a demand perspective, it's accelerating, not decelerating.
Earnings look great. Are they as good as they look? Lisa's asked this question before. A Bloomberg subscriber wrote in just moments ago and asked the following question, whether this is just about accounting tricks. The question directly is, someone's capex, which gets depreciated over many years, falls straight into someone else's top line, recognized instantly. No one predicted this earnings boost because no one thought this through. Not one single Southside analyst. What's your response to that?
My response would be look at Palantir earnings as a good example of just forget capex. Enterprises signing on the dotted line to ultimately accelerate their AI initiatives. If you look at Microsoft's quarter, that was a perfect example of what's happening to that. Just forget CapEx for a second. What are their install base, their enterprises saying? What they're basically saying is bright green light to go down the AI path. So when you go down to the CapEx and the circular financing and they're investing in there and everyone needs everyone else to ultimately be positive in terms of OpenAI and Anthropic, I think it gets away from just the core demand. And also, for every dollar of CapEx, there's a $5-6 multiplier.
It's not to imply that the earnings aren't there, they're not that great. I'm just implying that they're not as good as people might be saying they are. Is that fair?
I would say 6-9 months from now, they have to continue to execute and prove themselves out. And if they don't, then the stocks reflect that. But I think right now, that's why look, this is all a Jenga puzzle. From Palantir to Nvidia to Microsoft to OpenAI, Anthropic, you got to put it together to understand what's ultimately happening. What I would just say is, from an Asia perspective and what you've seen with demand's accelerating. That's why prices are going higher. And that's something that's bullish for the overall tech trade.
Dan, it's good to see you. Thanks for dropping by. Dan Ives there of Yorkville Ives. Equity futures pulling back this morning. Nasdaq futures down by 0.6 on the S&P, down by a similar amount. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. At least 6 people have been injured in a fast-spreading wildfire in Nevada. The Hawk Fire, northwest of Reno, has burned more than 13,000 acres and has prompted evacuations for nearly 90,000 residents. The blaze, according to the U.S. Forest Service, is, quote, human-caused. President Donald Trump's family is on the verge of having its own bank. The president's relatives and business associates have won a preliminary approval to start one. According to government data, it's now easier than any time in nearly 20 years to get a national bank charter. Italian tennis player Jannik Sinner is out of the U.S. Open. This coming on the heels of his decision to sit out of tournaments in Montreal and Cincinnati, seen as warm-ups to the Open. Sinner announcing his decision on X, citing his ongoing recovery from a right knee injury that has left him on the sidelines since winning the Wimbledon's men's singles in July. That's your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you for the update. Up next on the programme, easing bond market fears.
There's every indication that the U.S. Treasury market is functioning as it should. That enables us to focus on the federal funds rate as our primary policy tool to get inflation back down.
Up next, Kelsey Berro of JPMorgan Asset Management, live from New York City. You're watching Bloomberg TV. A long week ahead of us. Stocks slightly softer. We're down 0.25% on the S&P 500. On the Nasdaq, we're down by 0.6. In the bond market, 2s, 10s, 30s. Yields look like this. Yields at the moment pulling back by 2 basis points on 10s, on 30s down 2 as well. Your 30-year this morning at 5.25. Later on this afternoon, an address from the Treasury Secretary Scott Bessent on Iran. Many people in this bond market also waiting for that fiscal consolidation plan and wondering if it comes at the same time.
People were saying that after Scott Bessent said last week that not only would the Treasury be increasing the size of its buybacks of longer duration bonds, but also that there would be some sort of fiscal consolidation to respond to the $40 trillion problem in Washington, D.C. Unclear about whether that will come at the same time as Economic D-Day.
The Treasury Secretary speaking at 2 p.m. Eastern Time. Under surveillance this morning, easing bond market fears.
There's no sign of Treasury market dysfunction or breaking down in financial markets. There's every indication that the U.S. Treasury market is functioning as it should. That enables us to focus on the federal funds rate as our primary policy tool to get inflation back down. We have the freedom to do what we need to do to achieve our goals.
So here's the latest this morning. The Minneapolis Fed President Neil Kashkari playing down concerns over rising U.S. Treasury yields. Wall Street now looking ahead to Fed Chair Kevin Warsh's speech from Jackson Hole on Friday. Kelsey Berro of JPMorgan Asset Management writing, the fall of 23 offers a useful template. Multiple factors were needed to turn the market around rather than just one silver bullet. Kelsey joins us now for more. Kelsey, good morning.
Good morning.
Just explore that period once again, because it was around this time in 23, coming out of the summer into the fall, where things started to get a little bit difficult for then Treasury Secretary Janet Yellen.
Right. So that was a period of time where the 10-year Treasury yield breached 5%, and then it subsequently reversed. And when you look back at that time, a lot of people are drawing parallels to the movements of the Treasury and how that influenced the bond market. So back then, Secretary Yellen, at a refunding announcement, which I do want to highlight because what Secretary Bessent did was not at a refunding announcement. That was a true surprise. But at a refunding announcement, Janet Yellen changed the path or the trajectory for issuance to lean less heavily on the long end. I think the big surprise, thinking back, was actually the 20-year auction, which they announced no increases to the 20-year issuance. And that was one of multiple factors that ultimately got the bond market to start to turn around. The other factors, though, were really important. The Fed speak was a big and dramatic shift. Actually, back in September, the dot plot was very hawkish. The data started to turn the other way. The Fed's communication had to shift pretty quickly. And then by the December dot plot, they had completely reversed all of the hawkishness that they had previously had. So just for me explaining that, I think you can tell that there are significant differences between then and now, particularly as it relates to the data. This is a very resilient economy, and for that reason, the fundamentals do suggest that yields need to be higher. So when we're talking about stabilization, we're not talking about 100 basis point move lower in yields. But I do think that we do have some of the ingredients coming together, and I say that tentatively, to start to see the stabilization. The announcements of the buybacks are one thing. I think some of these economic surprises, which have turned a little bit softer, again, from very lofty levels, is another. And now I do think that the third piece of that puzzle could be the Fed communication and really understanding how the Fed has reacted to the more recent data. Because if you look at the July FOMC minutes, which we got last week, those were all prior to some of the more recent data points that we've been seeing, some of those which has come in a little bit more moderate, particularly on the inflation side. And when I look at the inflation markets, I actually see that the concern within the bond markets, to me, doesn't look like a bond market that's worried about overheating and runaway inflation. It really looks like a market that is trying to, in a fairly contained and gradual way, trying to price in higher term premium for more supply and some uncertainty as we head into the fall.
So how much influence does the Fed have then on the long end of the curve?
I don't think that they have a ton of influence, but they are one of the factors. And when I look back at where yields have gone this year and what the new information has been, to me, the new information is not really the deficit. I know that is the big headline because we surpassed 40 trillion, right? But to me, the new information 2026, one, it was the war and it was the rise in oil prices and the uncertainty that had on inflation. That is really still a big part of what's happening from a day to day. If you look at the correlation between the 10-year Treasury yield and oil, they're still trading very much in lockstep. I mean, after the announcement of the buybacks, the next day, oil was up 2.5%, and you saw yields higher. Today, yields are lower. Oil is also lower. So that's not a coincidence. But I also think that when you look at the other big thing that has changed is that we have new leadership at the Fed, and that is creating some uncertainty in the short term, and I think it's normal. It would happen regardless of who the Fed chair was going to be. But we've had a change of leadership at the Fed, and we're still trying to figure out how they're going to react.
Well, let's say we do get some sense of how they're going to react, or we get a sense of what Kevin Warsh's reaction function could be in his Friday speech. Would that make you want to buy 30-year Treasuries more?
I do think that it would be helpful if we understood his reaction function. I think one thing that is key is to understand how he thinks about the policy rate tool relative to his other tools like balance sheet. At the last press conference, he really kind of muddied the water in terms of what is their primary tool. If they're concerned about inflation, do they move the policy rate or do they look at other things? But I do think what is really important, I've been going around asking people, what is a good speech out of Jackson Hole on Friday, right? I think everybody agrees that they want something from Warsh, and they think that it's a really important moment from him. But when you start asking, okay, so what does that actually include to get that really important moment? The range of views is actually very wide. You have one camp that believes that the only way for him to really gain credibility is to sound very hawkish, is to hike rates, and that's the only way that you're going to get control of the long end. Then, and I'm in this other camp, I don't necessarily buy that argument. I think, on the other hand, you don't need to be explicitly hawkish or explicitly dovish to be credible. What you do need to be credible is to tell people what data you're looking at and tell people, what is important to you and how you're going to react in certain situations. But in the end, that's not going to change the data trajectory, the growth trajectory, or what's going on with oil. Those are out of the Fed's control.
Just really quickly here, if you get a better sense of his reaction function, at what point do you see people flooding back? I mean, this is something we were talking about before. You said maybe it could cause that. Do you think on the margins that could reduce risk premia?
I do. And, there's a number of things that are coming up that I think the anticipation is actually worse than the reality. So, for example, the investment grade market, expectations for September, the range of expectations is 175 billion in issuance next month to 250. That is a massive range. And I've talked to our credit portfolio managers, and they've said 250 billion is not really an issue for us, but we would like to know what we're going to prepare for. Are we preparing for 175 or are we preparing for 250? There is a possibility that we get into September and actually this demand goes fine. And then there is going to be a rush back into the market because what we've seen is that while there's been record supply, there's also been record demand. If you look at high grade flows, so retail demand for investment grade, that demand so far this year exceeds any full year back to 2010. So we are seeing that demand. And so if you start to see any stability, people are going to come back in.
Kelsey, it's good to see you. Thanks for being here. Thank you, Kelsey Berro there of JPMorgan Asset Management on this bond market. Up next, Ajay, Rajadhyaksha of Barclays, Gardner of Stifel, Troy Gayeski of Future Standard, Earl Davis of BMO. The second hour of Bloomberg Surveillance is just around the corner.
In terms of Jackson Hole, we do think that there is somewhat of an asymmetric risk.
The pressure is on for Warsh to say something more.
I think he was always going to come across as very dovish.
There's no way out of this. other than to tighten monetary policy.
The data is coming in so far good enough not to go in September.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your price action scores look like this. Snapping a 3-week winning streak on the S&P and pulling back again this morning. We're down by 0.3. On the Nasdaq, we're down by 0.7. In the bond market, yields on the week last week, basically unchanged to the long end, getting all the attention as the Treasury Secretary works very hard to keep yields going nowhere. 525 on 30s this morning. We're down 2 basis points. Heading into this speech, this address from the Treasury Secretary later on this afternoon at 2 p.m. Eastern Time, followed by the big one at the end of the week, bookended by 2 big addresses, one from Betsy and the other from Warsh, Jackson Hole, a few days away.
And those are 2 very connected events. The discussion from Treasury Secretary Scott Bessent and Fed Chair Kevin Warsh. How much are they working together? How much are they working at odds with one another? We've heard contradictory things on the bond market. Either the bond market's doing the work for the Federal Reserve and is absolutely a correct measure of the economy, or the bond market is mispriced and needs to be corrected. Which one is the correct version, and what exactly can Treasury Secretary Scott Bessent do, not only to curtail the rise of the long end of the yield curve, but possibly more importantly to curtail the conflict in the Middle East, which is intimately tied to the Fed rate hiking possibilities as well as the bond yield?
It's a major piece of it, Bramo. Pull up the bond yield curve, 2s, 10s and 30s, sit on the long end of 525. You can construct an argument, I think, with ease that this is where yields should be. The backdrop for supply, red hot. Nominal growth is really strong in America right now as well. Risk appetite's buoyant, equity still close to all-time highs. You can make the argument that 30-year yield should be at 525. We talked about this briefly in the past. Lots of people will come on the program between now and Friday and they'll say, we don't understand the Fed's reaction function. What they mean is they don't understand the chairman's reaction function. But I think we understand the Fed's. And you can see that in market pricing of the Federal Reserve for September. The data came in soft. People trimmed their bets on hikes in September. That's a decent understanding of how the Fed will respond to that incoming information. I think what the bond market doesn't like about that is that ultimately, if you're at the long end of the curve right now and you want a reason to get long, 30s, 10s, you need to see the outlook for nominal growth weaken from here. And you would need to see rate hikes. So what they want from Friday is a hawkish Fed to trim the outlook, to get yields to come in, not just for inflation, but also I think for growth. The backdrop for growth right now is really, really strong. There's one of many ways I can think of to get yields to come in. One is a growth slowdown. That can be engineered by the Federal Reserve.
Yeah, although is that something that's really a problem for the Federal Reserve? As Neil Kashkari said over the weekend,
not necessarily, Bramo.
This is normal, and it seems like it's not exactly causing an undue tightening in financial conditions. So the person it's a problem for is Treasury Secretary Scott Bessent and every American who's going to have to pay for a deficit that's increasingly consuming all of the budget tied to interest payments that are climbing at a very quick clip. That is the casualty of this, not necessarily financial conditions of the U.S. economy.
We've heard from how many guests over the last week or so who say this is a return to normal. We can go back to the pre-GFC world, live with the fives, the economy's doing okay, the market's doing okay. There's one part of this country that's not doing okay, and it's the Treasury Department down in Washington, D.C. They are deeply uncomfortable with yields at these levels, and they're trying to do something about it.
The other person is anyone who's trying to buy a house and who is looking at mortgage rates. No, actually, I was having this conversation over the weekend with my family. Someone older said, well, I remember when mortgage rates were this cost and and it was no problem. And I said, you know, Dad, do you know what the housing prices were then versus now?
He bought his house for a tin of biscuits.
And like, you know, really? And I mapped out the increase, and he was like, oh, that's a problem. I'm like, yeah, well, welcome to 2026.
Yeah, 100% debt to GDP ratios, right?
It was a fun,
We've got a problem north
weekend.
of that. Yeah. North of that. Coming up this hour, Ajay Rajadhyaksha of Barclays on Washington's uphill battle to fight long-term debt. Brian Gardner of Stifel as the US trade war with Canada escalates. Earl Davis of BMO on the uncertainty weighing down the Fed going into Jackson Hole. We begin this hour with stocks down and bond yields remaining elevated. Ajay Rajadhyaksha of Barclays writing bonds are cheaper than they have been in years gone by. They are still not cheap enough. Ajay joins us now for more. Ajay, good morning. Good to see you.
Good morning.
You think that yields maybe belong at these levels and perhaps should
they
go higher?
absolutely do, John. I mean, the big thing that has changed this year is not term premia running away from Treasury. It is simply that we started the year thinking 350 to 375 on the policy rate was restrictive. The Fed said so. And it's become increasingly clear that it's not. So the long-run neutral rate, as boring as that sounds, is what has gone up, and that is what is pushing longer yields higher.
Do you think to get yields lower, we need this Fed to get more hawkish?
Yes, there's no question about it. You need the economy to be weaker. That's the single biggest arguments for bond bulls to still stay in, and that's not happening.
If the Fed were to hike rates by 25 basis points, would that actually weaken the economy?
No, it wouldn't. And the reason, Lisa, is because, so one rate hike would not do it. One of the biggest reasons is because the single biggest driver of US growth is the AI capex cycle, and that is largely acyclical. It's happening almost no matter what interest rates are doing in the longer part of the curve. Look, there is a level, 7% on 10s, I'm making up a number, at which the Googles of the world say, look, I'm not doing any debt financing anymore, and start to pull back. But if high bandwidth memory tripling in price over the last 12 months didn't cause these guys to blink, the 10-year going from 425 to 475 is not going to do it. So, a 25 basis point hike doesn't do anything. At the very least, I think the Fed will probably need to signal, if they really want to slow down the economy a lot, that remember the insurance cuts of last year, the 75 basis points, they're saying, look, clearly that was not needed, we're going to take that back. But I don't think they'll do that.
Do you think that that would have a serious ramification on equity valuations? Do you think that that would have the biggest sort of transmission mechanism through lower lower equity prices that led to a slower wealth effect that would then drive a consumer spending slowdown?
So I agree with the second part of that statement. If there is a big pullback in equities, that clearly deflates the wealth effect. That is the one thing holding up consumption. That is the one thing holding up the real part of the economy. Because, like you guys just said, housing is not it, right? It's the AI cycle and the consumer. But the profit cycle is still so strong that I don't know that unless longer rates move significantly higher, the equity market pulls back a lot from here. Remember, last year we had a test case. April last year, look, we all have recency bias, but April last year, you were more scared. I was more scared than I've been at any point this year. The equity market pulled back 20%, and the consumer did not blink. So if it didn't happen then, I think you probably need a bigger pullback than that. And a 25 basis point, 50 bip rate hike doesn't do it.
There's a phrase that stood out in your mid-year outlook. It was long the cycle, short the complacency. Where's the complacency now?
It keeps rising. I mean, the 4 times you guys have had me on, right? My highest conviction on equities, being long equities, was on March 24th, if you remember, at the peak of the Hermes crisis. And every time since then, I've become a little more worried. I'm not prepared to go short equities at this point, even now, because US profits are stellar. It is hard to fight them. The big 5 banks reported a few weeks ago. Jamie Dimon comes out, says as good as it gets. So look, you said it yourself. The real economy is still holding up. But every 10 bip move in the 10-year makes me a little more nervous.
Situational awareness and positioning. When situational awareness got into trouble, people said that was a clearing event. The news into the weekend actually makes it just look like a bounce that Citadel sold into. Was it a clearing event or not?
I think it was a clearing event for that moment in time. I do think that if it hadn't played out the way it did, you might have had a significantly bigger initial pullback. But no, it doesn't solve the problem. The big problem is on the debt side. We used to have a clock in Times Square with the national debt. We just got rid of it, not because the debt improved. We ran out of numbers. So that I mean, even the Fed's, look, the Fed's inflation target, 2%, John, right? This is like hailing a cab in New York City. It's always coming. I walked here, so there's...
You couldn't get a cab.
Yeah.
But it's going to be 2% at some point, and that cab will come.
Well, here's hoping.
Right? That's the faith. Do you think the market's losing faith in that?
No. So that's the one thing going for the Fed. So if you look at longer-term inflation expectations, the Fed's inflation credibility, shockingly, after 6 years of missing the 2% target, is still very much intact. And I think part of the reason is because when they had to move, they had never done a 75 bip hike, if you remember. They did 3 months in a row. They were intellectually nimble, so the market's holding on to that. But at some point, 6 years, 7 years, 8 years of missing it, the market's going to start to get nervous. And that is not reflected in longer bonds yet.
Ajay, Mike Wilson over at Morgan Stanley came out with a note where he said that the biggest risk facing U.S. stocks right now is a huge spike in oil prices because it is directly tied to what the Fed does. And if you do see a sustained move higher in oil prices, that will force the Fed's hand to hike rates in some capacity. Do you agree?
No, I don't. I think, first, I dispute the initial assertion in that statement, because if we haven't seen it by now, If oil is still struggling to cross $100, despite, remember, we should have been in a global recession by now based on virtually every geopolitical analyst, right? If you had told them Hormuz is closed for 100 days, they would have all been jumping up and down, and here we are. That's part of it. But the other part of it is, I think longer rates grinding higher for reasons unrelated to spot events is the bigger problem. Because an oil price shock, the Fed often tends to look through that. They think of that as a shock, as a tax on the US consumer. They say, okay, this is ultimately going to slow down growth, and 12 months from now, it will come down. That I don't think is the problem. The problem is that the one part of the US economy that is vulnerable, that we are doing nothing about, is our debt profile.
So you've been on, 4 continents in the past, week?
In the last 2 to 3 weeks.
2 to 3 weeks, which makes me really amazed that you're upright. You've been talking to a lot of investors from around the world. Has the view of buying U.S. assets and dollar-denominated assets shifted with some of the questions around the Treasury and Fed coordination and some of the comments from Kevin Warsh?
No, but it hasn't improved. So if you remember, last year was actually worse because there was a global trade war. A bunch of our neighbors were upset with us. Sentiments were running high. If you went to Canada, there were parts of supermarkets which say US products and no one shows up. That was the sentiment at that point. It hasn't improved very much since then. And a couple of points that clients made over and over, they said, which is true. They said the Iran crisis was tailor-made for the US dollar. The United States is a gigantic energy superpower. The euro area is not, and that is 70% of the dollar basket, and the dollar still struggled. So the dollar weakness is showing up, but it's showing up in terms of the dollar not appreciating when it's supposed to. But the world is not running away from dollar assets. It is at the margin buying less of it in the fixed income side than it used to. That's all that's happening.
Ajay, it's good to see you. I still have not seen a coherent argument as to why we've taken on our northern neighbours to the extent we have done in the last 18 months.
I mean, it used to be a South Park joke to take on Canada, blame Canada, and why we're here now, I'm not sure. But I will say that the sentiment's still pretty negative and that tourists from Canada have not come back to the United States.
Jay, it's good to see you. Thank you, buddy. Ajay Rajadhyaksha there of Barclays. It's not turning around that story, is it? Carney's getting more and more annoyed based on the news conferences we've seen. And in the meantime, the backdrop for that economy, and this is the difference right now, the backdrop for the Canadian economy really is not great at all.
There are some estimates saying that the latest moves will cause a job loss of about 90,000 in Canada. There's a question about the hit to GDP. And frankly, he is going to get more popular, Mark Carney, going hard against the United States because of the sentiment, the visceral reaction that people have, even if there is some sort of economic loss.
Let's get you an update on News Worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Tensions escalating between the US and Iran. Treasury Secretary Scott Bessent signaling plans for fresh sanctions today and threatening a, quote, economic D-Day. Tehran threatening to seize vessels that violate transit rules in the Strait of Hormuz. SoftBank is planning Japan's biggest retail bond sale, raising $6.3 billion with 7-year bonds expected to price September 4th. The sale would refinance maturing debt and back the company's push into open AI and data centers, chasing computing power in the global tech race. Fast fashion giant Shein is set to go public in Hong Kong September 1st, raising up to $1.8 billion in its IPO. The company is offering 280 million shares, bringing in cornerstone investors, including Tencent, General Atlantic and Tiger Global. Shein's valuation around $27 billion, but that's 70% below that peak valuation. That is your Bloomberg Brief. John.
Bonnie, thank you. Chump change, isn't it? 2 billion these days.
I mean, that's
it's
nothing.
2 billion.
What's 2 billion between friends? 2 trillion? Then we can start talking.
It's like Alphabet sneezing one morning.
Sneezing $1 billion.
It's nothing.
It's sort of like me.
Up next on the programme, escalating a trade war with Canada.
I warned that America is trying to break us so they can own us. And I promise that that will never, ever happen. Canada is becoming stronger and less dependent on America, and we are just getting started.
Up next, Gardner of Stifel, live from New York City this morning. Good morning. This afternoon, 2 p.m. Eastern Time, the Treasury Secretary Scott Bessent addressing this nation and the difficulties in Iran, calling it economic D-Day for Tehran. 2 p.m. Eastern Time. Look out for that later this week. We'll get some consumer confidence numbers on Tuesday, on Wednesday, PCE data after the close on Wednesday, Nvidia earnings, and then the chairman of the Federal Reserve, Kevin Warsh, addressing Jackson Hole, Wyoming.
I want to go back to what Kelsey Berro was saying, which is, what is a good speech from Treasury Secretary, not Treasury Secretary, Scott Bessent, from Fed Chair Kevin Warsh. It's interesting to conflate the two at a time when those two are intimately intertwined. Is it something where he talks hawkishly, or is it something where he just gives some sort of reaction function or explains why the Federal Reserve did not hike interest rates at the last meeting? Ultimately, how much is this market just looking for clarity on his views versus a sense that he is prepared to hike rates?
I increasingly believe the long end, if you are long, the long end, you want a hawkish speech from the Federal Reserve chairman. And I think clarity on a reaction function only goes so far, because ultimately what you do want is clarity on a hawkish reaction function from this Fed chair. And that's what's missing.
Yeah, maybe. And ultimately, you can make the argument that the hawkish approach lost clout in the wake of a lot of the economic data that showed more disinflation. So ultimately, how much can he deliver something that the market's going to be happy with?
Futures this morning down about 1/3%. On the Nasdaq, we're down by 0.75%. Yields 2/10s, 30s. Yields coming in. Some better news for the Treasury Secretary going into this afternoon. 5.25 on 30s. Yields in a basis point or two. Out of Savannah's this morning, escalating a trade war with Canada.
I warned that America is trying to break us so they can own us. And I promise that that will never, ever happen. We are keeping that promise. Canada is becoming stronger and less dependent on America.
So here's the latest this morning. Trade talks between the US and Canada officially breaking down. Canada firing back against steep 50% tariffs with a $20 billion counter levy. Sources telling us here at Bloomberg that Prime Minister Mark Carney's government sees little chance of negotiations resuming before the midterm elections. Bloomberg's Tyler Kendall joins us now from Washington for more. Good morning, Tyler.
Hey, John, good morning. Well, we got even further signals that Canada is preparing for the long haul, with Canadian Prime Minister Mark Carney going on to say that he will roll out a domestic aid package designed to help businesses that have been hurt by the tariffs. And Canada is preparing its own retaliatory measures set to go into effect on September 8th, further risking the tit-for-tat escalation could continue. From here, the breakdown marks a pretty sudden reversal, considering that we had heard relative optimism from both sides just last week. In fact, I asked President Trump directly about the potential deal, and he said that it was done, just that the details needed to be finalized. But now both sides are blaming each other for that failing to happen, with the USTR, Jamieson Greer, confirming that the U.S. was set to lower sector-specific tariffs on metals and autos and potentially eliminate altogether those levies when it comes to lumber. But Canada says there were just too many disagreements on too many things, including some critical nuances, John, such as alleging that the U.S. didn't want to see tariffs extended for medium and heavy-duty vehicles like trucks.
Tyler Kendall with the latest in Washington. To build on this, Brian Gardner of Stifel. Tyler, thank you. Brian, welcome. Let's talk about why we're doing this. Why is the U.S. going after Canada to the extent it is going after Canada?
I think it goes to the fact that, in my view, that the president sees economics and trade as a zero-sum game. I think that's the simplest, most accurate explanation for this. So if Canada loses, the United States wins. I don't think he believes in as much of a win-win scenario that has underpinned U.S. trade policy, global trade policy, for the last 40 plus years. So I think that is the explanation.
Brian, we still have USMCA. When you see numbers like 50% on some goods, how much of trade are we actually talking about? How much falls under USMCA and how much falls under this spat right now?
This is this is still a fairly low percentage of overall trade with Canada. So we can't blow it out of proportion. But the tone, the way the negotiations collapsed, the way that USMCA has been evolving, it does call into question on what changes are coming for USMCA. What is the long-term implications for North America trade? I mean, it's kind of amazing that we're sitting here Going into the Trump administration, you would have thought that U.S.-Canada relations would be in a better place than U.S.-Mexico relations, and they're exactly the opposite. I think we're in a better place with Mexico and more likely to get longer-term agreements with Mexico than we are with Canada. It's pretty remarkable.
Brian, there was a belief that going into the midterm election cycle, there would be some relief from tariffs, or at least the threat of them, to reduce the cost of living. Do you think that that playbook is gone?
No, I mean, I think they're still there, Lisa. I mean, the cut in tariffs on beef imports recently, I think that that underscores the worries of the administration, their perceived vulnerability on affordability going into the midterms. But look, when you go into any kind of negotiations like this, various parties can overplay their hand. And I'm not going to point fingers. Maybe it was the Canadians who thought, because of what you just said, maybe they thought going into the midterms that they had a stronger hand to play and that they could get a better deal. And taking a page out of the Trump playbook, maybe it's, the art of the deal. Maybe once in a while you just walk away from a deal, from negotiations, and force the other side to reconsider and come back with a better deal. Maybe they're playing a longer game for this. But to your initial question, Lisa, no, I think the administration is still very concerned on affordability, and that's why they're lowering tariffs on other products.
The reason why I ask is because there was this reported meeting between House Democratic leader Hakeem Jeffries and Jared Kushner in the past couple of days, talking potentially, we're not sure, but reportedly talking about how to work more closely together. If the Democrats win the House, this would be the person who would have to work most closely with the administration. Do you think that that is a significant tell that this administration is preparing for a divided House and gridlock for the second half of President Trump's second term?
Yes, and I think they understand reality. Look, they're going to pull out all the stops to either keep the numbers low or defy history. But they know what history is, which is that the party out of power, the Democrats, are likely to pick up seats in the midterms. And since they only need 3, the bar is pretty low. And so I think it's just facing reality as it is, doing the correct outreach. Jeffries himself is going to be in a very difficult spot. So maybe because he's going to have a fractured conference with some new DSA members, some more mainstream members who are opposed or in conflict with the left wing of the Democratic Party. And so I think the administration is taking the correct steps and doing some outreach. It's going to be a rocky 2 years, but it doesn't mean that you can't talk to the other side and see maybe are there some areas of common ground, some areas where you can avoid conflict unnecessarily.
Brian, in Trump 1, a lot of people complained about the tariffs on China. Then under Biden, very few, if any, were cut. In Trump 2, a lot of people have complained about the tariffs on everybody. And yet I see very few people, if any, campaigning to cut them into the midterms, Brian. Why is that not part of the conversation?
Well, I think among the public, I don't think the tariffs are overly popular with the public, but they do resonate with key constituencies. And so I think politicians, members of Congress looking at this just don't see any reason to go out and advocate very few of them will advocate in favor of rolling them back. Maybe Rand Paul from Kentucky, one of the few, but most of them. I mean, let's go back to the beef import example, because that got a huge amount of pushback domestically from U.S. producers. And so, ag is a big constituency in the United States. Steel is a big constituency in the United States. Auto is a big constituency in the United States. So it's not in their political interest to advocate for the lowering of those tariffs.
That's the political reality in this country at the moment. Brian Gardner of Stifel. Brian, thank you. Many people don't like them, but some special interests want to keep them.
Which is the reason why they play well in specific elections at specific times.
What joy, what fun into the midterms later this year. Troy Gayeski of Future Standard joins us next. The opening about 2 hours away. Equity futures retreating by 1/3 on the S&P. On the Nasdaq, we're down as well. On the Nasdaq, negative by 0.7. Tough start for tech. Nvidia, 6-day run of losses. heading into earnings from that company on Wednesday after the closing bell. That is your headline earnings act for this week. Into the bond market, 2s, 10s, 30s. Yields look like this. The headline act for this, probably Fed Chair Kevin Warsh. Might be the Treasury Secretary later this afternoon at 2 p.m. Eastern Time. 30s at 5:25 will certainly get his attention in a few hours' time.
Yeah, there are two prongs to any kind of potential Treasury market intervention, especially given Operation D-Day or what we could potentially see with the economy in Iran. A question here about how much this could bring down oil prices, key for the Treasury market. And another question is, how will this continue to affect international relations with countries that have been purchasers of Treasuries and their willingness to continue to have that economic connection or potentially not?
It's D-Day for the bond market too.
Oh, I don't know if that's yeah. Hopefully not, because we don't need to have more analogies of bombs being dropped in the bond market.
Military intervention in the bond market.
I think that this might be what we're talking about with respect to bringing in the troops of economic warfare. I don't want to.
Can we find that sound so we can play it for the audience a little bit later, just in case you missed it over the weekend?
I don't think we can do justice.
I know there's lots of noise before the president takes off to wherever he's going, and I assume he just didn't hear the question.
Yeah.
Or thought it was about Iran. It's something else.
That's what a lot of people are saying, is that ultimately they must have to do that. I don't think that he's sending tanks down to Wall Street to blow up the bull.
We'll dig that out in the next 60 minutes or so. 2 hours away from the cash open. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
And that bull may be made out of steel, John, right? Well, we are seeing the steel makers gaining this morning after trade talks between the U.S. and Canada broke down. That means those steep 50% tariffs on Canadian imports are staying in place, giving domestic steel producers some protection from Canadian competition. But as you and Lisa were talking about earlier with Brian Gardner, Canada is not standing down. It is hitting back with tariffs on U.S. steel starting September 8th, as we see an aggressive Mark Carney over there. Meanwhile, we are seeing Alibaba ADRs weaker, down 2% after raising more than $10 billion in a record follow-on share sale over in Hong Kong. And it comes just after Alibaba reported results last week, where it posted profits that plunged 75% as AI spending ramped up for that company. So now it's turning to shareholders to raise even more money for that AI push, which is, of course, a diluting event. And we turn to another Chinese e-commerce company. This is PDD, the company behind Temu. Shares are rising 2.3%. The company profit beat estimates, but they did fall 12% from last year. And it comes at an interesting time because we know that Shein has filed to go public in Hong Kong, but at nearly a quarter of the valuation it once had on the private market, showing that regulatory concerns and weaker sales are weighing on this bargain app sector. John.
Yahara, thank you. Thanks for the update. More from Yahara in the next hour. On our radar this morning, the Treasury Secretary Scott Bessent expected to unveil new sanctions on Iran, writing in the Financial Times, quote, "At dawn begins an economic D-Day. Our objective is to sever every economic lifeline until Tehran stands alone." Elsewhere, Nvidia raising prices on AI servers by more than 15%. The hike driven by soaring costs of memory chips is set to take effect on systems shipped early next year. Nvidia set to report earnings on Wednesday. And finally, the bipartisan backlash against AI data centers gaining more momentum.
They had not been working in collaboration with the state. They'd not been working in collaboration with local governments. And so they basically dug their own grave. And that's why they got the backlash they deserve. And that's why these new standards are in place to make sure they're not going to be able to operate until they come into compliance with the standards that I have set.
The Texas governor, Greg Abbott, adding only 10% of data center companies responded for requests for information.
This is fascinating, given the fact that Texas is ground zero when it comes to the data center build out. This had been the state that had welcomed in so much of the data center build out. You saw some of the licenses, some of the permits getting approved in just a matter of days to build some of these centers. It's the reason why so many have gone there. And Greg Abbott has talked about how the dynamism of AI will fuel the growth of the country. He was asked repeatedly about this, and the governor said, well, the data centers and the tech companies have failed to get the support of local communities, and it is their failure that has led to them tightening the reins and really clamping down on just how much ends up being approved. So ultimately, where is the onus? Is it on government officials that are feeling the heat from their constituents? Is it on tech companies? Is it on both? And ultimately, how much will this constrain some of the ambitions of AI?
We're not surprised we're here. We're surprised how quickly we got here. At the start of the year, there was a feeling this would become a political issue, but maybe not this fast. You can see this in a survey, a poll that Politico did earlier this year. They did one at the start of the year, and they did one about a month ago. These were the results. The new poll found that 41% of Americans would oppose a data centre being built within 3 miles of where they live. That's up from 28% in the January survey. The numbers supporting those projects have dropped over the same period from 37 to 24. That's a big shift in about 7 months. The shift was especially pronounced among people who said they had voted for Kamala Harris in the 2024 presidential race. You can see why this has become a big issue heading into the midterms.
Well, and Governor Abbott said, frankly, talking about the tech companies, the data center builders, they dug their own grave. They got the backlash they deserve. And I wonder how much that is a discussion around the job apocalypse that some people were talking about, the fact that a lot of AI build out would eradicate jobs. And frankly, the higher energy bills that a lot of people have seen without the offsetting benefits that a lot of the AI companies are seeing. Put those two things together, along with a lot of bad PR in a whole host of different places, and you understand why there's so much backlash, whether it crimps the ambitions of the United States or not.
Some reporting from CNBC just moments ago, Bramo, I want to share with the audience regarding the bond market. This from CNBC just moments ago. The Treasury could use the general account to fund the bond buyback. This citing a senior Treasury official on Treasury plans. How the buyback would be funded was a key piece of the conversation over the last week. Would it be funded by just an increase in T-bill issuance to fund the doubling of the buyback at the long end, or would it come from the Treasury general account? According to CNBC reporting, the Treasury could use the general account to fund the bond buyback.
There's about $1 trillion or close to it in the general account. And what this would do is it wouldn't necessarily lead to a direct and immediate increase in short-term Treasury bills to offset any kind of share buybacks. There are a lot of questions here. I mean, honestly, we just still need to understand exactly what the ultimate goal is, what prompted this. And, you know, if you buy an extra $4 billion in auction or each operation, again, how much is that going to solve faster growth, higher inflation, and a competition for capital around the world?
Yield's coming in a bit. At the long end of the curve and across the curve, we're down 1 at the front end. We're down 3 or 4 basis points on 30s this morning at around 5.23. Yields coming in off the back of that headline. Let's talk about what's happening elsewhere. Wall Street gearing up for blockbuster IPOs with debuts for Anthropic and OpenAI reportedly on deck this year. Troy Gayeski, a Future Standard, writing, private markets are holding up. AI concentration is becoming a portfolio issue. Capital is increasingly concentrated around AI across both public and private markets. Troy joins us now for more. Troy, it's been too long, my friend. Welcome back to the programme. This is a question so many of us have asked. Are we all in the same trade?
Yeah, I think the concentration has gone up substantially. I mean, most of the press and most of the analysts focuses on public markets where you have more and more tech and AI concentration, which is fairly obvious. But I think what's happened this year, particularly in private markets, is more and more capital, whether it's going for go-go growth or whether it's going for AI infrastructure, has really increased substantially. And so when you think about the use case for alternatives, you know, one of the principal use cases for something like middle market private equity has always been growth at a reasonable price. But what's becoming more and more important is that diversification away from AI risk. Because in the event that there isn't a meaningful AI ROIC to justify the continued growth or even the sustainability of the current growth in spending, that could lead to obviously a very negative economic outcome, not to mention a tougher outcome for public and certain types of growth-oriented private market exposures.
Troy, what are the opportunities like elsewhere? And to what extent are they being crowded out by the issuance we're seeing from the Treasury, that we're seeing from, let's just look at this morning, SoftBank planning to raise $6 billion in Japan, Alibaba raising $10 billion in Hong Kong, the AI players, the hyperscalers issuing tons and tons of debt. How much crowding out are you seeing?
Yeah, so I think, again, if you look at opportunities for growth away from AI, you know, we focus on middle market private equity, where a lot of the exposures are what I refer to as boring is beautiful. Things like mobile payment applications or paving or specialty foods. You know, these are good core businesses that make up about 1/3 of private sector GDP. However, in other areas, there are other growth factors like robotic surgery or infusion care. There's a lot of growth now tied to defense. So the argument isn't that you shouldn't own AI or AI risk. It will more than likely turn out fine. However, if it doesn't turn out fine, it's good to have an exposure in your portfolio that can provide you growth-like returns without that singular level of concentration risk.
How much do you find a lot of the positions that you're looking for are increasingly crowded? Because people have been talking about GARP or growth at a reasonable rate for a while. And then we saw the Russell 2000 surge. I know it's not what you're talking about with private markets, but it is a proxy for smaller companies and the dynamism that people are foreseeing. At what point does it get too crowded as people just sort of chase something that can be relatively immunized from that larger potential risk?
Yeah, well, it's really interesting because to John's point, the crowding has happened more in terms of AI and AI infrastructure. However, because there's a dearth of capital, the returns that you can make there are still very attractive. Now to your question, Lisa, what's really interesting is this year we've seen, particularly in our co-invest pipeline, a tremendous level of deal activity. And the reason for that is pretty straightforward. You have very strong nominal GDP growth, and many of these small and medium private enterprises need capital just to meet the demand backlog because of the demand shock we're seeing across various growth verticals, including defense and, again, other niche areas. So that's the principal reason the pipeline is on fire, and we just haven't seen any evidence of crowding out in that niche area of the market. Now, to your point on the Russell has been on quite a tear. And as a reminder, the Russell trades more expensively on a PE basis than the NASDAQ and on an enterprise value to EBITDA basis than the S&P, but typically is giving you much lower revenue and earnings growth. So, we're rooting for the Russell. We're not saying it's a bad place to put money. It just strikes us as very expensive relative to larger indices that are out there with better growth prospects.
Joy, as benchmark yields go up significantly, particularly in longer term debt, how much does that change the calculus when it comes to private debt versus private equity?
Yeah, so most private debt is priced at the front end of the curve, right? So if you think of the back end of the curve, that's really an issue more. This steepening we're seeing is more of an issue for long duration fixed income, obviously for IG markets, for Secretary Best, and unfortunately, in the front end is where the anchor rate is for private debt. It's a SOFR plus market. So having the Fed lower rates by 175 basis points so far has reduced interest expense for private borrowers by about 15%, which is substantial, right? That has led to an increase in credit quality. We don't expect further pressures in the front end. We're not expecting the Fed to actually hike rates. So that will keep borrowing pressure lower. And ultimately, in the event that the Fed cuts over the next several years, that will further increase floating rate borrower credit quality, which as a private lender is very, very important.
Troy, it's good to see you. Thank you, sir. Troy Gayeski there.
Great to see you as well.
Thank you, buddy. On private markets and alternatives. Get back to that headline that crossed about 5, 6, 7 minutes ago across the Bloomberg terminal. The HAP drive yield is just a little bit lower across the curve. You can bring up bonds, 2s, 10s and 30s. You can see this move on 2s, on 10s, on 30s. A report suggesting that to fund the buyback at Treasury, that the Treasury could use the general account to fund it. That coming from CNBC a little bit earlier this morning.
So what the general account is, it's kind of like a rainy day fund. It's taken from taxpayer collections. This is not coming directly from the proceeds tied to different issuances of bond offerings. The reason why this would potentially be positive, it's this exogenous source of capital going into the bond market, particularly directed at the long end of the yield curve. Again, the urgency to this, why this is happening now, and whether it's going to come in tandem with something else all remains to be seen. Nonetheless, that's been a big question mark. Where would this financing come from? Would it come from the bond market itself, just in a different denomination? Or is it going to be externally financed? And this provides maybe a window into what the answer is.
The word could, doing a lot of heavy lifting on that headline there. Let's get you an update on news elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Just to summarise all of that once again, Treasury Secretary Scott Bessent could reportedly use its near $1 trillion general account to help fund those buyback plans. CNBC citing 2 senior Treasury officials for information. The Treasury Secretary is set to speak today at 2 p.m. Eastern. At least 6 people have now been injured in a fast-spreading wildfire in Nevada. The Hawk Fire northwest of Reno has burned more than 13,000 acres and prompted evacuations for nearly 90,000 residents. The blaze, according to the U.S. Forest Service, is, quote, human-caused. Iranian oil shipments to Asia virtually drying up ahead of fresh U.S. sanctions. Treasury Secretary Scott Bessent set to detail a plan for, quote, the greatest coordinated economic isolation in the history of the world. And that is your Bloomberg Brief. John.
Vonnie, thank you. Thank you very much for the update. Up next on the programme, setting the stage for broader buybacks.
I think that once the market understands that we are focusing on fiscal consolidation and that we are trying to bring the market back into equilibrium in a thinly traded market.
Up next, Earl Davis of BMO. Stocks down. We're down by 0.15 on the S&P. We're down by 0.5 on the Nasdaq 100. In the bond market, 2s, 10s and 30s. Yields coming in off the back of a series of headlines just moments ago. We're down 3 basis points on 10. We're down 3 basis points on 30s. 523, let's call it 524 on a 30-year bond yield. Under surveillance this morning, setting the stage for broader buybacks.
Anything that happens within a 24-hour period is noise. And, I think that once the market understands that we are focusing on fiscal consolidation and that we are trying to bring the market back into equilibrium in a thinly traded market, we were left with a mess.
So here's the latest this morning. The Treasury Secretary Scott Bessent could reportedly use its near $1 trillion general account to help fund buyback plans. CNBC citing 2 senior Treasury officials for information. Earl Davis of BMO writing Bessent has complicated the Fed's job through increased buybacks and verbal intervention. This uncertainty adds to confidence in our call for an unchanged target rate for 2026. Earl joins us now for more. Earl, good morning and welcome. Does it matter to you, what significance is it for how this is funded, whether it's through the general account or whether it's through T-bill issuance?
Does it matter? No. Is it significant? Not at all. And the reason why is the general account is funded by T-bills. That's how they got up to $1 trillion. It just didn't appear that way. So what is the general account used for? Most recently, it's been used for the government shutdowns. That's what pays the employees, the government, federal employees, while the government shut down. And once there's no more money left, that's when they actually go off of work. With most likely a government shutdown, at least talk of it for 2027, this thing about using the Treasury account is going to be very short-lived. It's going to shorten that window, and then it has to be refunded up to a level that they set as a proper reserve at $700 billion to $1 trillion by T-bills. So no, it has absolutely no effect or impact on our view on the markets.
So, Earl, you were looking for 5 on 10s in 27. Have you got reason to bring that forward into 26?
Possibly, but it's not a 10-year story. It's not an economic story. It's just a 30-year bond story. And the thing that's not being spoken about, this is not a U.S. phenomenon in regards to 30-year yields going higher. Actually, U.S. is the last major developed market to the game of steepening yield curves. This is a global phenomenon, and there's reasons behind it. So it's going to be very hard to fight it. So what gets us to 5%? We think there's a higher chance of 30s hitting 6% first, then 10s hitting 5%, despite 30s being 75 basis points away from 6% at 525 now, and 10s being, call it, 35 basis points away from 5%. The reason why we think that, it's the pressure on the long end and the long duration risk. There's a lot of mark-to-market risk with that. There's not as much with 10s. We are big buyers of 10 years at 5%, that 5 to 525. We also believe that is the trigger or Fed act or Treasury action and possibly action with the Fed in regards to market intervention. So we believe there'll be a big backup if we're buying 5-year yields between 5 and 5.25.
Yeah, but you said that you would not necessarily be a buyer of 30-year yields at 6%. Yeah. Why?
I wouldn't touch it at all. So let me go very quickly through bond math. A 30-year bond has a duration of 20 years. What that means is if you get a move of 1%, so 525 to 625, you times that by 20, your duration, that's a 20% mark-to-market hit. The equivalent on 10-year bonds on duration, let's call it 6.5 on 10-year bonds. So if you get a move of 1%, and it's 6.5, that's 6.5% or 650 basis point. Your coupon pays you back for that within a year. So there's significantly less risk in owning 10 years. I could go through the bond math all day long, but that's what I love about fixed income. That's what excites me about this market. You get paid at par, you have a duration. It makes sense to buy 10-year treasuries at 5% to 5.25 and corporate bonds on top of that.
Earl, is this a long-term debt problem or is this a U.S. problem? You talked about the global issue, but I would pose this question to you, and we've asked it many times on this show to different guests. Would you be more comfortable buying 30-year debt from, say, Meta or Microsoft or Amazon than the U.S. government because there are these extra yields, but also potentially revenue streams that are coming down the pike?
That is a fantastic question. I'll try to keep the answer simple. The reason why 30-year bonds and yield curves are steepening around the world, it's being led by Japan. Japan has steepness between basically their 2-year bonds and 30-year bonds of 300 basis points, let's call it. US, it's only about 110. So we could go to 300. So why is Japan doing that? You know why? Because they've gone from, they basically used inflation to lower their debt load. And now they're actually running a primary surplus in Japan. So steep yield curves are actually could be good for the economy because banks make more money. When banks make more money because they borrow short, lend long, they end up lending more to the economy, loaning out more. So it's actually growth productive. The final thing I would say is, too, the deregulation move in the U.S. is real. Underlying growth is solid. So, yes, if we move 10s to 5% or 30-year bonds to 6%, it's going to be turbulent. And it's like a plane, though. You go through turbulence, you could drop 500 feet, but you'll survive as long as the captain's telling you what's going on. And that's what we feel here, that, you know what, we will survive. The turbulence will be rough, so you got to fasten your seatbelts. But there is significant opportunity around the corner. And again, that's why our team is built for this. We love being active managers, and we love being in fixed income, and we think there's significant opportunity not too far away.
So why are you trusting, cutting and trimming corporate credit risk right now?
Because the market doesn't like volatility. We think because valuations are so tight, the valuations will reset. Not persistently, temporarily, we will be large buyers. So to your point, there's a saying we like saying, we like the movie. We love this movie. We're just getting a seat closer to the exit right now based off all the people in credit and risk on, but we're still risk on. So what we have done, we've sold all our high yield in the US. We're still long high yield in Canada. And we bought all IG. And we bought all IG in that 2 to 3 year bucket because we know we'll be able to convert that to cash and buy high yield again when spreads go wider. I would say the sectors we're looking at are financials for the reasons that it's steeper yield curve. Financial, we like aerospace and defense. Those are two sectors, and energy. We really like energy as well, too. And those are the three sectors we're looking at for any pullbacks.
Oh, so much to chew over there. Thank you, buddy. Earl Davis there of BMO, both on the corporate side and on the sovereign side. On the sovereign side, that's quite a statement, isn't it? I think that we'll get to 6 on 30s before we get to 5 on 10s, even though 6 is 75 basis points away on 30s and 5 on 10s is only 30 basis points away.
And then taking it a step further and saying, and I wouldn't touch that 6% yield with a 10-foot pole.
Right.
Even though, but they would be buyers of 10-year Treasury yields. A real question here about just the fate of duration in a steepening yield curve environment with Japan leading the charge.
I'm going to go back over that conversation a little bit later this morning. Up next on the programme, Anne Walsh of Guggenheim, Momei of PSP Growth, the former Fed Governor Betsy, Kelly Covley of Manning and Napier Advisors. The third hour of Bloomberg Surveillance, up next.
You're seeing this upward pressure on bond rates.
The Treasury won't have enough power to control the 30-year yield.
There are just too many competing factors out there that are moving long yields.
Markets do not want to see anything standing still. They need to see action.
Markets are telling you what they will do if the Fed continues to sit on its hands.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your price action scores look like this. Equity futures on the S&P 500 pulling back by 0.15, down 0.5 on the Nasdaq 100, heading into earnings from Nvidia in a few days' time. Tech on a weak run. In the bond market, 2s, 10s and 30s, some stabilization at the long end of the curve. Yields coming in by 3 or 4 basis points, 5.23 on 30s heading into this week right here. The Treasury Secretary speaking later on this afternoon. In a few days' time on Friday, you'll hear from the Fed Chair, Kevin Warsh.
So a real question here, how much is Fed Chair Kevin Warsh responsible for what we've seen at the long end of the yield curve? Is a lack of some sort of clarity around reaction function, reasoning behind why the Fed remained on hold part of the driver of the sell-off in long-term treasuries? Or is it really tied to what we're going to hear at 2 p.m. today from Treasury Secretary Scott Bessent and some of the external factors, whether it's the Iranian war or just generally the U.S. sanctions and the requisite response by international players in the Treasury market? These are all questions that we don't have answers to, but this week should offer some clarity.
We've had a 30% move on crude since the war started, a 60 basis point plus move on 30-year bond yields. You've seen record issuance in high-grade corporate debt in America in June, July and August. You've seen supply kick off all around the world. The Fed contribution to this, I think it's as follows. Do you believe they are sufficiently restrictive or not? Many people believe they are not, and that's contributing to high yields at the long end in a very hot nominal growth world in America right now.
Yeah, and then there's another question. How much does the Fed have to care? Is this a problem for the Fed, the sell-off that we've seen at the long end of the yield curve? Or ultimately, if they're looking at inflation in the labor market, does it not factor into it because it is not necessarily unduly restrictive based on the underlying environment? Is this a problem for the Fed or is this a problem for the Treasury? And increasingly being made a problem for the Fed. I mean, ultimately, these are some of the questions that we don't really have answers to because growth is strong and because people are able to borrow and because you are seeing just a general dynamism, is it a problem if inflation is running at a level that it's not clear exactly what the Fed's role in this should be, let alone what it is?
I would draw a distinction between the Fed and the Fed Chair. It's a problem for the Treasury, which makes it a problem for the Fed Chair. And it's a problem for the Fed Chair because the Fed Chair said he was using markets to get some kind of unfiltered signal. It's not unfiltered anymore if the Treasury's getting involved.
It's a problem for the Fed Chair if he has to answer to President Trump. And frankly, if people view him as being a very political person, which increasingly he has been just by virtue of the president's rhetoric.
Let's get into this market. Equity futures this morning down by 0.2. In the bond market, yields a little bit lower, down 4 basis points at the long end of the curve, 30s at 5.23. A conversation about how those buybacks would be funded. CNBC reporting a little bit earlier on this morning they would be funded, potentially, could be funded with the Treasury general account. As we heard from Earl Davis of BMO, what difference does that make? Because ultimately, the general account has to be rebuilt. It's rebuilt through issuance, through T-bills.
His answer, does it matter? No. Ultimately, is it going to have any kind of ramification on the market? No. And ultimately, you're seeing the move fade just a little bit. It's a question. How much control does the Treasury have at a time where there's some real fundamental factors here that are driving where yields are going?
Massive call from Earl. 6% on 30s before you get to 5 on 10s.
And wouldn't touch it with a 10-foot pole?
Like, wow.
Yeah. Let's get into that.
That's quite a call, isn't it? Coming up, we'll catch up with Ann Walsh of Guggenheim, previewing a high-stakes week for Wall Street. We'll catch up with Momei of PSP Growth, with Nvidia warning of rising costs ahead of its earnings, and the former Fed Governor Betsy on why committee members aren't changing their policy views anytime soon. We begin this hour with stocks sliding as investors brace for Fed Chair Kevin Warsh's speech on Friday. Ann Walsh, the Chief Investment Officer of Guggenheim Partners Investment Management, writing the Jackson Hole meeting is an opportunity to clarify the strategy to address inflation. The hawks have grown louder, but inflation progress should be enough to avoid hikes this fall. Anne joins us now for more. Anne, good morning. Good to see you.
Good morning. Glad to be here.
Before we get into this, as you know, I imagine you were anticipating us getting into the issues around Mark Walters and his affiliation to Guggenheim more broadly. I'm going to go through the details as we understand them. As I understand them, whether these loans from insurers were directed to other parts of his empire without being properly disclosed and labelled as affiliated transaction. That seems to be the epicenter of the investigations right now. I'm sure clients are very interested in where you stand and what it means for Guggenheim Asset Management. Where does Guggenheim Asset Management sit in all of that?
Well, let me see if I can create some clarity around this. In particular, what is not the focus of any inquiry is to our investment management process, our people, our performance and returns, or our trade allocations, which has historically been an area that the SEC would open an inquiry into an investment management firm. And that is not the case here. We are working day in and day out for our investors with the same integrity and fiduciary responsibility that we have always engaged in at the firm, and will continue to do so, in particular at this time with markets being so uncertain. We do have an inquiry into a business accounting issue in one of our subsidiaries, and we've been very open with regulators and very cooperative in their investigation, and we will continue to do so. And that, as I said, is a business issue. We've engaged with our auditors, and we feel that the accounting treatment was appropriate. With regard to TWG and its insurance entities, that is a fully separate matter. And of course, they are dealing with their regulators and have been also very cooperative, and as I understand it, have entered into a remediation agreement or a protocol. And that has been, as I said, very cooperative. At this point in time, I think investors need to be assured that we, again, are working very much diligently day in and day out, again, because these markets are so uncertain.
How cooperative have clients been over the past few weeks?
Very supportive. And once it's very clear to them exactly what is happening, and we are able to explain, then as a result, we have been able to assure them and I think, again, assuage their concerns.
Do you think that the climate has adjusted such? You keep saying that markets are incredibly complicated, and they are. And we were talking about, for example, Nvidia and some of the accounting mechanisms that have been going on with respect to where they book profits versus the hyperscalers as they spend. Do you think that rumors spread faster right now because people feel like there's so much money being spent? It's such a difficult, fraught time with so much money going to private sectors with less transparency.
Well, look, this is the world within which we are operating. The markets are highly fragmented and stratified. So at this point in time, what we're seeing is the interest-sensitive parts of the economy are maybe a bit more wobbly. We're going to talk about rates. That's obviously having an impact. We're talking about private markets have grown significantly over the last number of years. And with BDCs and some of these other transactions, particularly concerns over software, we're starting to see a lot of investor nervousness. And by the way, we're coming up into that time of the year, September and October, which historically is a market volatility period of time. And as a result, investors are more nervous than probably they would otherwise be.
We were just talking with Earl Davis, who said he's going to the back of the theater near the exit door, talking about how he's looking for 10-year Treasury yields to go between 5 and 5.25%, and 30-year Treasuries to go to 6%, but he still wouldn't buy them. Do you see things the same way?
I think that's a very provocative statement. What I would say is that here we are in a trading range on the 10-year. And at the low end, we've been down into the high threes. At the high end, we're 470, 475. And at 475, that's pretty much the high end of our range. If we see 5% on Treasuries on the 10-year, I would tell you that is a buying opportunity. I think the markets aren't able, particularly the equity markets, aren't really able to function as well beyond that. And I do believe it tightens financial conditions. The 30-year, however, historically has traded much more on inflation concerns. I don't see us going to 6% on the 30-year, and if it does, I would take the opposite view and I'd back up the truck, and I'd buy a lot of 6% 30-year Treasuries. I think that at this point in time, what we're also seeing, I said stratification earlier, we're seeing that also in the pull up. Another factor that's happening, and that is the sheer amount of debt that's being issued, not just at the Treasury level from fiscal spending, but also because of data centers and AI trade, the AI trade that's happening at this point in time. And as a result, we're seeing this very significant amount of need for capital, and they want to issue in the long end, which is pulling rates up.
Do you want to invest in that debt, long duration, hyperscaler debt, or do you see that as potentially more toxic than U.S. government debt should things turn south?
I think there are other parts of the infrastructure trade that make a lot more sense. Power build out and other kinds of long-term real asset investing. My concern about the data center build out and the cost of that is the obsolescence risk in the long term. Now, I am selectively an investor in shorter duration offerings, but we have to be thoughtful because the AI offerings that are coming out of the capital market are not in just one place. They are in unsecured investment grade credit, they're in structured credit, they're in infrastructure. So you have to be really thoughtful to make sure that you're getting the right amount of diversification. There's trillions of dollars of capex in this space that is happening over the next several years. And as a result, there's going to be continued need for capital. And I think being thoughtful and layering in is probably a better way to be investing in this space going forward.
And so much of that is investment grade rated debt. Earl Davis of BMO, Lisa was talking about the 6% call. The other interesting take he had, he was de-risking on the credit side, but dropping all the high yield exposure and then refilling at the front end of IG. What do you think the risk is in credit right now? Because we've had a series of conversations that have raised the question as to whether actually it might be sitting in investment grade and not in high yield with regards to this story.
Well, the high yield market has actually shrunk over the last number of years anyway, and has actually moved up in credit quality. It is a very different market than it was, say, 10 years ago even. With regard to the high level of capital issuance and debt issuance that's happening, particularly in the long end on investment grade, to fund this AI build-out. And by the way, I'm very positive on the AI technology in the long run, but I am concerned in the nearer term with regard to the risk that's happening. And simply, again, that stratification that's happening, because there's so much issuance there, that is demanding a higher level of coupon. And for me to get invested, it has to be paying a lot more, and that makes sense to me as an investor. The risk is elevated, and there is concern. And of course, we've become much more aware of the fact that these issuers are free cash flow negative at this point in time, and I think that's something to be concerned about. Whenever you see historically a huge amount of debt issuance, whether it's the fiber optic cable build out of the late 1990s or the financial crisis, the lead into the financial crisis where there's so much debt came out, anytime you see that, you have to sort of say to yourself, I think we need to be thoughtful with regard to this concentration of risk and to be aware that it could have repercussions to the credit market.
Do you think this Fed needs to tighten financial conditions?
I think the Fed has done something with the beginning part of the year in that they increased their balance sheet in the ample reserves regime to, by the tune of about $300 billion in the first 6 months of the year. Those purchases have now stopped. And I think that it was confusing to the market. This is one of the elements that I think Chair Warsh is going to be spending time on. He's already mentioned it, is the evaluation of how does the balance sheet act as a tool. And I think that's a very important initiative for the Fed to take up. And I would say that by increasing the balance sheet by $300 billion, that's the equivalent of about a quarter percent rate cut. And so they've been actually somewhat stimulative, along with the one big beautiful bill, the tax benefits, fiscal spending. I mean, and tariff refunds. This has been a very heavily stimulative first half of the year, relatively speaking, that I think actually slows down and may even come to a stop here in the second half. And so I think that investors need to be aware that financial conditions are probably going to naturally tighten. And to Kevin Warsh's perspective, I think the market is going to do some of the Fed's job for them.
Unless Besson has other ideas. Anne, appreciate it. Anne Walsh of Guggenheim, thanks for dropping by. Appreciate your time, as always. Let's get you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Treasury Secretary Scott Bessent could reportedly use the Treasury's near $1 trillion general account to help fund buyback plans. CNBC citing two senior Treasury officials for information. The Treasury Secretary is set to speak today at 2 p.m. Eastern. Trade talks between the US and Canada falling apart following President Donald Trump's threatened 50% tariff on some goods from Canada. Canada's US Ambassador Mark Wiseman telling us here at Bloomberg that talks between the two nations collapsed over the inconsistencies in the fine print. Canada Prime Minister Mark Carney now planning to implement counter tariffs on $20 billion worth of US products effective September 8th. President Donald Trump's family is on the verge of having its own bank. The president's relatives and business associates have won a preliminary approval to start one. According to government data, it's now easier than any time in nearly 20 years to get a national bank charter. And that is your Bloomberg Brief. John.
Ivani, thank you. Thanks for the update. Up next on the programme, the morning calls plus Momei Q of PSP growth with Nvidia. Warning of rising costs ahead of earnings in a few days' time. Live from New York City this morning. Good morning.
The largest companies in the world financing the largest infrastructure build in any of our lifetimes are still raising capital to increase that capex more, which is driving an unprecedented earnings cycle. That's what's driving markets higher, and that's got to be your North Star.
That's powering the earnings. That was Steve Chiavarone of Federated a little bit earlier on this morning. Equities this morning pulling back just 0.2% on the S&P following a week of losses. Likewise on the Nasdaq, down by 0.6 on the Nasdaq 100. In the bond market, 2s, 10s and 30s. Yields shaping up as follows. We're down 3 basis points at the long end of 5.24. That's the price action. Let's get you some morning calls. First up, Jefferies raising its price target on CrowdStrike, saying it's in, quote, pole position for the AI security race. Your second call from Citi raising its price target on BJ's Wholesale, expecting a stronger second half of the year. And finally, Wells Fargo raising its price target on Marvell, predicting more potential upside after its deal with Google. That stock is still down in the pre-market. It's lower by 3%. Nvidia telling its biggest companies to its customers to expect AI server price increases of more than 15%, with the chip maker set to report earnings on Wednesday. Bloomberg's Ed Ludlow has more. Good morning, Ed.
Yeah, good morning, Jonathan. The important bit to underscore is this is at the server level. This is according to sources who have seen communications from those companies that assemble NVIDIA-based servers and sell them to cloud computing operators or data center operators. And the bottleneck and pricing pressure is still high bandwidth memory. This is not NVIDIA going direct to the market and saying we're raising prices 15%. But that's its traditional sales channel. You have an OEM, it assembles the server, puts the NVIDIA GPUs in, and then sends it to the data center operator. It's interesting, like one Blackwell GPU or one Rubin GPU has 8 corresponding stacks of high bandwidth memory. And so, that is where the real pressure point is. But it's also kind of not that surprising a story, right? We kind of have waited to see how NVIDIA will have to play this market in that respect. And it is a company operating at margins of 75% or more that is just sort of out of this world for this industry. What it decides to do on behalf of its customers and what it decides to do going forward is interesting. The one other critical point of this report is this is for 2027, system shipping in the new year. And I'm sure that there'll be posed questions out on the call.
Ed, thank you, buddy. Looking forward to the programme and your coverage of it. Bloomberg Tech, about 3 hours away. Momei Q of PSP Growth writing Nvidia sits in the centre of the AI supercycle. It is seen as a report card on the entire sector. Simply beating earnings will not be enough to move up its market cap. Momei joins us now for more. Momei, welcome. We often say this. It comes so late in the reporting cycle that there's little left to really know after we've heard from their biggest customers. What are you waiting to find out in a few days' time?
Hello, good morning. NVIDIA has a pretty tough job this week. So if you think about it, not only do they have to defend the incredible business that they have today, but more and more they have to tell the investor world that they will continue to be the AI platform of tomorrow. NVIDIA has beaten earnings 9 straight quarters. If you think about their data center revenue, it's still growing at nearly 100% year-over-year growth, which is pretty remarkable at their scale. But yet, as we've seen, it has not been enough. The stock has struggled to rally after each of these earnings, and we're left thinking, what more can they do in order to prove out that they can move their stock prices up? Some of the things that I think we'll be paying attention to, and you saw some of this news come out over the weekend and over the last week, is NVIDIA is expanding into other areas of the AI stack. Their licensing, $6 billion licensing agreement with Poolside is their method of reaching into the model layer. They are thinking more about how do we reach into the end customer with a rumored investment into Perplexity? This is their answer, and I would expect to hear more around Rubin platforms, potential robotics, in order to tell the market not only are we still performing really strong fundamentally in our core business, but will continue to evolve and become relevant in the future.
They have to confront the politics as well, Momei, and I wonder if that's becoming a big story for them too. That the data centres that house the things that they sell, there's a public backlash in this country at the moment, Momei. Could that trim growth in the near term, in the medium term, for this corporation?
I believe that will contribute to some of the volatility. I think that's an issue that will need to be solved and need to have more conversations around. As you know, PSP is backed by former Secretary of Commerce, Penny Pritzker. She is one of the chairs of an initiative called Raise Us that's actually tackling the issue of how do we ensure that workers are prepared, the public is prepared for this AI wave, because as we've seen, some of the backlash is really real. And one of the reasons is this is all happening so fast. If AI is the industrial revolution that we can claim it to be, all past industrial revolutions has had a longer adjustment period for the population, for the workers. I think the productivity will come, but it's really hard to bridge that gap right now between the increasing spend, the increasing data, the increasing spend, the increasing CapEx with the population that's still adjusting to what does this mean for me and what does this mean for my job.
Momei, how much focus is there going to be on Nvidia's investment portfolio? How much they continue to plan to finance the entire ecosystem? Because that has been at the backbone of so much of the AI build out.
I think that's another piece of evidence that this build out is still not as mature as people think. As you saw, their way of investing into OpenAI is essentially funding the whole ecosystem and their customers while the AI curve matures and enterprise adoption actually happens. I don't think Nvidia is the only one doing this. You see Google making a significant investment into Anthropic, $40 billion, even when they have Gemini as their own model. So this shows to me that while there is this enthusiasm for the AI build out, people are also hedging their bets because they don't know which model or which infrastructure or which part of the stack the value will eventually accrue to. So they're placing bets across multiple parts of the ecosystem in order to propel the overall market, but also so they have different bets along different parts of the AI ecosystem.
Momei, appreciate it. It's good to see you, as always. In a few days' time, the big one, Nvidia reporting after the close on Wednesday. Momei Q of PSP Growth. At the moment, it's just a massive political story ahead of the midterms, but at some point, it becomes a business story. If you don't get the approval to build the data centers, where the purchases for Nvidia chips, additional equipment, going to come from?
Yeah, ultimately, you've seen this sort of race to build data centers in order to front run the regulatory crackdown. The regulatory crackdown is happening a lot faster. How much Nvidia can respond to that, how much they can speak to international demand they could potentially offset any clampdown in the United States, and how many commitments have already been made that haven't necessarily been built out yet that will still be a source of demand.
6-day slide on Nvidia, the longest since September 2022. Up next on the programme, the former Fed Governor Betsy on why committee members aren't changing their policy views anytime soon. Plus, Chiavarone has your morning movers. Steel stocks surging as US-Canada trade talks collapse. The opening about 60 minutes away. Equity futures sliding by 1/10% on the S&P, on the Nasdaq 100 down by 0.5. In the bond market, 2s, 10s and 30s defending the 30-year bond yield, becoming a bigger and bigger issue. Yields are down by 4 basis points on 30s right now, 5.23. How do you defend the bond market? We promised you this sound a little bit earlier in the program. Take a listen to this exchange with the President of the United States.
Did you direct Secretary Betsy to intervene in the bond market?
No, not at all. He is a good touch, very good natural touch for the bonds and interest, and he did that.
Have you talked to him about another type of intervention?
We have many types of intervention. That's one. The ultimate intervention is our military, and if we have to use that, we will.
Bond traders everywhere, getting ready to hide under the table.
I was about to say, going into our bond bunkers.
Where are they going with this?
The bond market or the bond market. I mean, it sounds similar. You can understand. I mean, there are all sorts of jokes that you could say. Let's prevent the Treasury market from getting a nuclear weapon,
I'm guessing / hoping that he just misheard the question. and didn't mean any of that.
That's what we're all kind of guessing
Right.
and hoping, but it's unleashed some really colorful memes. I recommend you check them out because people are very creative out there.
The precedent there on the bond market, maybe we think, perhaps not. 1 hour away from the opening bell. Let's get you some morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. We're back to trade news moving stocks with the U.S. steel makers rising in the pre-market. Names like Nucor and Steel Dynamics up as trade talks between the U.S. and Canada broke down over the weekend. That means those steep 50% tariffs U.S. tariffs on Canadian imports are staying in place, giving domestic steel producers like these a leg up against Canadian competition. But as we've been talking about all morning, Prime Minister Mark Carney not standing down. They announced that they are hitting back with tariffs on U.S. steel starting September 8th. Meanwhile, let's turn to Applied Optoelectronics. This name is down 12.5% in the pre-market, but it has had a strong run. One of the biggest winners in the AI trade, up more than 200% year to date, but it's taking a hit today after announcing plans to raise up to $600 million by selling new stock, which of course is a diluting event. And this could also be why you're seeing some other optical stocks like Lumentum and Coherent falling in the pre-market, but that's not it. We are seeing a risk-off mood in the market that is hitting the AI trade, with the biggest winners like SanDisk also falling. Part of that could be that with earnings season largely behind us, you don't have that steady stream of good results helping to prop up this market against higher yields. And you also don't have results yet from the most consequential name in the AI trade, Nvidia, which of course reports on Wednesday. John?
Yahara, thank you. Thanks for the update. Thanks for this morning. Let's get to a high-stakes week for the economy, kicking off today with the Treasury Secretary Scott Bessent and wrapping up Friday with the main event, Fed Chair Kevin Warsh's debut speech at Jackson Hole. Mike McKee getting out there early. He joins us now for more. Good morning, Mike.
Good morning, John. Well, it is a very big week out here as members of the Open Market Committee, their staffs, and central bankers from around the world convene in Jackson Hole. Now, the symposium begins Thursday night, although the action is on Friday, and everybody's eyes are going to be on Kevin Warsh's first speech there at 10 a.m. Eastern Time. Should run about 20 to 30 minutes. It will be broadcast on TV and radio, and of course, there is no Q&A, so it is just whatever he wants to tell us. And he hasn't been clear about that. He said he might talk about what's going on with him and the reforms, or he might talk about something else. The subject this year is financial innovation and what that means for payment systems, which doesn't have a lot of interest for people outside of the trading desks that do that. Wall Street's expectations are a little bit stronger. They're expecting to be high level, not get into the nitty gritty, and they will justify the reforms that he is wanting to talk about. Now, traders are divided on whether he'll give us a reaction function or not. How far does he want to go? Because he doesn't want to offer forward guidance. And we don't know if he's going to speak about the communications, whether they'll continue the news conferences, and whether he'll go into any detail about what the minutes revealed of him wanting to move back to 6 meetings a year. As you mentioned, a big week, so we'll all be looking to the bond market, which you've been talking about all morning. Michael Hansen at JPM put together a really handy list of how the markets have reacted to Fed Chair's speech at Jackson Hole since 2000. He looks at the 2-year, which is the most sensitive to the Fed, and you can see Ben Bernanke kicked it off with his speeches on instituting buying bonds, the LSAPs programs, the quantitative easing programs, and he had a lot of movement there. Jay Powell in 2019, remember the ructions we had in the markets then, Powell again in 2024, and his last speech last year seemed to have a big effect on the markets. But you know what's missing there? 2022, that was the 8-minute do whatever it takes speech, and that only resulted in a bond move in the 2-year of 2 basis points. So it isn't clear exactly how the markets are going to take all this. And I suppose the most important news for Lisa this morning is that temperatures seem to be a little bit warmer in the early morning hours this week.
Mike McKee, the most important piece of news for Lisa is that you've got a sofa in your room this year. You seen this?
I don't think that's his room.
Mike got an upgrade.
Is that your room? Is that your room?
I wish this were my room. I'm in Jackson itself for a couple of days.
Okay, there you go. All right, because the rooms themselves, not great. Not
You know,
great.
they're rustic.
Not great.
They're,
Rustic's
for somebody,
one way of putting things.
For somebody who grew up camping regularly for vacations, there's still an upgrade from that.
Mike McKee, thank you, buddy. Appreciate it. The former Fed Governor Betsy writes the following: nothing in recent data is likely to change any committee member's policy views. Warsh will stay away from normal press conference type updates. He will be in control of the discussion. Betsy joins us now for more. Betsy, good morning and welcome back to the programme. What is on the to-do list for the Fed chair this week?
Well, this is the most important speech that the Fed chairman makes every year, and it's a way to sort of set the stage. It's not in front of Congress. It's not in front of the press. He won't take questions. And so it's a real opportunity, and I just can't imagine Kevin letting this opportunity go by and not doing something with it.
There was some criticism, Betsy, of how he delivered the news conference a few Wednesdays ago. There was an attempted clean-up act. It's been called that by many in the Financial Times the week following. What do you think is left for him to clarify, to use this opportunity to clarify the message?
I think he's going to have to use this opportunity to talk more big picture, possibly to talk about, I would expect him to talk about these 5 committees and what he's charged them with. He may or may not give an update on what sort of progress they're making. He has talked about the big questions, and I think he needs to talk about what are his big questions. He's been very critical of the Fed over the last several years, and he needs to talk a bit about how he's going to approach reform, not necessarily forward guidance, but just what sorts of things structurally in terms of the framework for decision making is he thinking about.
One aspect of this, Betsy, is a sense of where we are in the economy. I mean, he hasn't really given his economic report card or view of kind of state of play in any capacity. Do you expect him to do so?
I don't expect him to make comments about the current state of the economy, because that drifts a little bit into forward guidance, into talking about what they might do. So I think it's going to be more about sort of if he talks about the economy, about the overall strength and resilience of the U.S. economy.
Do you really think that that's forward guidance, to give a view of why the Fed remained on hold at the last FOMC meeting? I mean, it seemed like low-hanging fruit to explain the arguments and the reason that they decided to make a decision. Does that count as forward guidance?
So I agree with you. I was very disappointed that he didn't talk about how they came to the decisions that they did, which, as you say, is not forward guidance.
Betsy, do you think the action of the Treasury just last week is undermining the effort of Fed Chair Kevin Warsh?
No, I don't think so. And the Treasury takes its actions entirely separate, and I think the Fed will view that as in line with the Treasury's fiscal responsibilities and take it as a given in terms of how they make their decisions.
Because one thing he said in the news conference, and you'll remember it, is that he was hoping to take an unfiltered message from the bond market. How filtered is that message now?
I don't think terribly filtered, because it's not easy for you or me, but it's fairly easy for Fed staff to tease out what is the signal to be taken from the markets and what's coming from the interventions.
What do you think the message from markets is right now with regards to how restrictive this Fed is or isn't?
I think the markets are looking for more restriction from this Fed.
Part of the information that we're looking for in the markets, in the analyst community, is what gauge of inflation they're using. There were some questions about reassessing the inflation metrics. Do you think that the updates of the task forces will give some guide as to what they're looking at now or how they're going to guide policy before the conclusions of those task forces?
So that task force may have something to say about how they will express their targets. So if it's not core PCE, if it's something other than core PCE, that's going to require a lot of explaining and perhaps a new target. So if it's not core PCE, maybe it's not 2%. I don't know really when the Fed makes its decisions, it's looking at a whole range of different measures of inflation. It doesn't just look at one measure.
The other aspect that people have been scratching their heads about is whether the interest rate tool is still the primary tool of this FOMC in terms of combating inflation. Do you expect that to change?
I don't expect that to change at all. In fact, I do expect some reduction in the use of the balance sheet tool over time. That's just going to be a question of how do they accomplish that, and how do they do it without disrupting market functioning.
Betsy, it's good to see you. Always is. Thank you. The former Fed Governor Betsy Duke there, heading into that speech from the Fed Chair Kevin Warsh, criticised widely about his performance at that news conference a number of weeks ago on several issues, two of which flirted with the idea that PCE is no longer the preferred gauge for inflation, that they'd move on from that. Some people seeing that as just moving the goalpost. The other issue being the balance sheet versus interest rate, that we could use the balance sheet instead of interest rate, and that opened a different can of words for this market as well. Some of that was clarified in the Financial Times piece. I think you wanted to hear that from the man himself in the speech this Friday.
Yeah, there's a question of which part of the yield curve is this FOMC that wants to lean on? Do they want to lean on the front end? Do they want to lean on the long end? The Treasury clearly is trying to work on the long end. Are they going to then pin interest rates where they are at the Federal Reserve? How independent of the moves in the long end of the yield curve will their actions be? I mean, there are a lot of questions that we don't expect answers to. Let's be very clear. That said, if he doesn't give anything, the bond market reaction will be fierce as well. And I think that that is the tell, is that he can't say nothing without a reaction. Saying nothing is doing something. And that ultimately is why a lot of people are anticipating this quite significantly.
That will send a message.
Correct.
And the market heard that message that Wednesday in that news conference, and it sold 30s as a result.
People fill the absence of information, and we see that repeatedly. And so people are filling that an absence of an explanation is a desire to stay on hold or do whatever you want without having to explain yourself. And that is not being received well in markets.
Let's give you an update on news worldwide. Heading into all of that with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Tensions escalating between the US and Iran as Treasury Secretary Scott Bessent signals plans for fresh sanctions today and threatens a, quote, economic D-Day, with Tehran threatening to seize vessels that violate transit rules in the Strait of Hormuz. Nvidia has notified some of its biggest customers of price increases on servers containing its AI chips as memory costs soar. Systems, including those with Verro Rubin and Grace Blackwell chips, will be impacted. Costs are rising more than 15% in many cases, beginning early next year. President Donald Trump rounding out celebrations of the nation's 250th birthday with a first-of-its-kind IndyCar race through the Capitol. 27-year-old Florida native Kyle Kirkwood winning the race for the Andretti Global team, beating out 24 other drivers. And that is your Bloomberg brief. John.
Vonnie, thank you. Thanks for the update and thanks for this morning. Up next, we'll set you up for the day and the week ahead. Plus, Kelly Covley of Manning & Napier Advisors joins us to look ahead to all those events. Live from New York City, you're watching Bloomberg TV.
The markets are highly fragmented and stratified. We're starting to see a lot of investor nervousness. And by the way, we're coming up into that time of the year, September and October, which historically is a market volatility period of time. And as a result, investors are more nervous than probably they would otherwise be.
That was Walsh joining the program a little bit earlier on, the CIO of Guggenheim Partners Investment Management. The price action this morning looks like this. Equities down by 0.2 on the S&P, on the Nasdaq down by 0.6. On the S&P 500, snapping a 3-week winning streak on the S&P 500. Nvidia into earnings on Wednesday on a 6-day slide. In the bond market, 2s, 10s and 30s. Yields look like this morning, 524. On 30s, we're down by 3 basis points. On 10s, we're at 471. Earl Davis of BMO. Check this out for a talking point to start your week. 30s right now are about 75, 76 basis points away from 6%. 10s right now are 29 basis points away from 5. Earl thinks you've got a bigger chance of getting to 6 on 30s before you get to 5s on 10s. That speaks to a very untethered 30-year bond.
It talks to a steepening yield curve that he sees stemming from Japan, which is allowing their yield curve to steepen significantly, and it already is significantly wider than here in the United States. This is the debate. How much has the 30-year Treasury yield become untethered to fundamentals, economic fundamentals, inflation, a whole host of other pictures as a result of the glut of debt internationally, as a result of AI-related instruments, and frankly, doesn't have as much connection to the U.S. economy as it has traditionally. The 10-year is a different story, and that's the reason why Earl was talking about the potential for intervention more significantly in the 10-year, because that would cause some fissures in markets.
We haven't had a big move on 30s so far this month. In fact, last week, not a big move at all. The headline, and we've repeated it, the headline on 30s was how hard we had to work to keep 30s from going anywhere. And given that work, the dollar was down on the week. Gold was up by something like 5%. Bitcoin up by more than 20. The so-called debasement trade is in focus. Ray Dalio, founder of Bridgewater, out on LinkedIn over the weekend. I suggest diversifying well in asset classes and countries that have strong income statements and balance sheets and are not having great internal political and external geopolitical conflicts, underweighting debt assets like bonds, overweighting gold, and a bit of Bitcoin.
Yeah, and this has been a call from him for a while. He also warned that a U.S. debt crisis could be just 3 years away in that piece. On the flip side, there was a report put out by Mark Seidner over at PIMCO saying they'd be a buyer at this level. So, look, this is what makes a market. You have different views, and ultimately we'll have to see how much the Fed and the Treasury really have influence over this market by the 1-2 punch, the bookends of this week.
You'll hear from the head of the Treasury and the head of the Federal Reserve. This week looks like this then. Your trading diary shaping up as follows. At 2 p.m. Eastern Time, the first of those two bookends, the U.S. Treasury Secretary Scott Bessent discussing sanctions on Iran. On Tuesday, consumer confidence and Fed speak from Barclays. Wednesday, PCE data and Nvidia earnings. Another round of jobless claims on Thursday. UMich consumer sentiment on Friday. And then the Fed speak really kicks off. The headline act. Fed Chair Kevin Warsh speaking at Jackson Hole.
To me, I am curious, to Kelsey Berro's point, what makes a good speech from Kevin Warsh? What do people want to see? And I think that in the conversation, and you pointed out that a number of the bulls on 30-year treasuries like to see a hawkish Fed, and other people are saying we just want to see exactly the state of play for the economy and some sort of reaction function. Whether we get either is unclear. That also will be a tell to markets.
Kelly Covley of Manning & Napier Advisors writing the following. The market is increasingly one-dimensional, with the AI-linked theme representing the ever-growing share of equity and now bond markets. Kelly joins us now for more. Kelly, welcome to the show. How vulnerable is the stock market to a bond market issue?
I think it's quite vulnerable. So we are reaching the point now where yields are approaching levels that have historically been problematic for the equity market. And I think so far the market has been willing to look through this to some extent because earnings have been so phenomenal. And one caveat on those phenomenal earnings is that a large portion of that came from mark-to-market gains on equity securities. You also have that mismatch between all that CapEx spend where revenue is booked by someone immediately and the expenses are spread out over future periods. Frankly, those adjustments really only get you from phenomenal earnings growth to really fantastic earnings growth. Like, you can't get it to a bad number, but we also want to keep in mind that a lot of these earnings are cyclical in nature. It's one thing if, say Coca-Cola has this strong of earnings growth, you might extrapolate that level of earnings out to the future. But with these cyclical earnings, it's not a scenario where you want to price something at peak earnings for the foreseeable future.
Kelly, nobody's really talking about the prospect of a growth slowdown. How cyclical do you think some of these tech stories actually are? Could they stand up to a cyclical test?
I think the biggest test would be if you had a deceleration in revenue growth for the AI laboratories. That's sort of the best gauge of end demand for the AI story. And we do have so many interlinkages now built in around that AI theme. Not only the financing backstopping, that is a little bit circular in nature, but you've also had gains from all that CapEx spend spread through to industrials and utilities and real estate. And you've also seen that boost consumer spending via the wealth effect.
What would you rather own, Kelly, the stocks or the bonds of some of these AI-related companies?
I think the bonds at this point are not unattractive on an individual basis. These companies, even if you take into account some of that off-balance sheet lending, they are still not particularly leveraged relative to a lot of the rest of the market. Demand could be a bit more of a gating factor than creditworthiness. But I think the more interesting thing for the market is just how big that amount of debt has become. It's backed by an immense amount of earnings, but it's just such large amounts in dollar value, and it's disproportionately longer duration. So it makes up a disproportionately high share of broad bond market risk.
How sensitive is this broader equity market to what Kevin Warsh says on Friday?
I think it is quite sensitive. That being said, his benefit will be expectations, I think, for this event are lower than they have been for prior Fed chairs. You sometimes do get hints of policy to come. I don't think we're going to get that type of forward guidance here. You might get some evidence of his reaction function, and it's been quite rare that we don't have that going into this event. So it's a low bar. I think the market would receive any indication of a reaction function favorably. And then if he gives any indication of a real commitment to keeping a lid on inflation, I think that would be very well received.
Kelly, it's good to see you. Thanks for dropping by. Kelly Covley there of Manning & Napier Advisors. The commitment to anchoring inflation at 2%, how are you going to do it? This was the Mike McCree question in a news conference a few weeks back, a month ago, and it wasn't answered very well.
Is it the bond market doing the work for you? Is it the interest rate tool and the potential for rate hikes? And frankly, the FT story suggested that rate hikes could still be on the table for Kevin Warsh should inflation run hot enough. But that's not enough. I mean, for somebody who wants to not use shadow news as a way of telegraphing points of view, you would imagine that they would want to put that on record.
I don't do guidance, but I do leaks to the FT, kind of.
Maybe.
Yeah, all right. Fun and games going into Jackson Hole, Wyoming in a few days' time. Bramo's going to be on her way, what, Thursday?
Yeah, I'll leave.
Going to lose you on Thursday.
Yeah, he'll lose me on Thursday.
We won't lose her tomorrow. She'll be catching up with Scott Kirby of United Airlines. Look out for that. We'll also catch up with Kit Jukes of SocGen, Lisa Shannon of Morgan Stanley, Megan Swiber of Bank of America. From New York City, thank you for starting your week with Bloomberg TV. This was Bloomberg Surveillance.